I need capital, right? That capital can be arranged through two ways. One is the owner himself or herself is contributing, or the owners are collectively contributing. Another one is borrowing. Borrowing can be made through issue of debenture. Okay, or you can go and borrow from a bank. Borrowings are having so many ways in it you can do, but popular way of borrowing is issue of debenture. Yeah, like that. Any other question? The
So which
person who is
means,
having the debenture is called debenture holder.
okay, sir. So which
Yeah,
means it is also a liability, right, to the company
it
who is
is a
borrowing.
liability. It is a liability. It's a liability. Yeah, very good. Anybody would like to address this? This gentleman is asking, can we know the difference between the shares and debenture? Both are giving money to the company. Yeah, in the form of capital. If that is the case, what is the difference between these two? One at a time. Yes, sir. Mhm. Okay. Is it so? Suppose company does not have any money at all to pay, where the company will get the money from and give to debenture holder? He is telling it is compulsory to pay off the debenture holders. That's the meaning, right? Yes, sir. Suppose if the company does not have any money at all, huh? That time also debenture holders will be paid off. Even I am investing in equity share at that time also I am seeing only, no, whether the company is capable of giving me some profit or not, company is good or not. I am seeing that also in. One second, one second. One second. Let him complete. Something is, this gentleman is using some word, not during liquidation. All of you are able to get that word? Somebody is telling no. Yeah, liquidation. What is liquidation, sir? Your starting point itself is having a problem. Closing the company. Layman's understanding. Closing. Once for all. Winding up. Closing. Liquidating. Okay, liquidated. Okay, company is liquidated then. First. Okay. That's the only chance. It's not compulsory. First, we look at debenture holders because they are creditors of the company. Equity shareholders are owners of the company. So in that way, they are different from each other. Payment of interest is compulsory for debenture holders. Payment of some return to the equity shareholder is optional. It's optional. Even though company is having a profit, company does not have profit, there is no concept of giving dividend or sharing the profit. Okay, arising. But if the company is having profit, that time also it's option of the company. It's a shareholders collective decision whether to take some amount of profit as dividend or not. Dividend means part of profit distributed to shareholder. Dividend, the share of profit available to shareholder. That is not compulsory, even at the time of having profit in the company. But whereas in debenture holders case, payment of interest is compulsory irrespective of profit or loss. You are borrowing money. Suppose you are borrowing and studying education loan. Sir, I taken education loan 8 lakh rupee. After taking loan, I studied MBA, but I could not get any job, so I don't pay any interest. Bank will allow you? Okay, so we have to pay interest on loan. Simple concept. That's a loan. This is an own money. That's the difference. They won't pay. I did not tell, no. I told interest payment is compulsory. That's every year payment. Every year payment. For that also, if they don't have money, they don't pay. That's all. Then what is the? You will study that in the next semester. We have answer, but that is not the subject matter of this subject. Okay, which is good? Debt or equity? How these two are having positive and negative sides of it. And how do we go about it? Finance manager should decide. But we accountant should just record what finance manager has decided. Yeah. Accounts is not handling money. Accounts is writing how the money has been handled. Okay. Finance is handling money. You cannot go and ask, hey accountant, give me 10,000 rupees. He will not give you and he is not authorized to do so. What he will do? He will ask you, give me the bill, I will write it. I want money, then I am not responsible. Where you have to go and ask? Cashier. Cashier. Okay. But in some place, cashier will also be an accountant. Accountant will also perform the job of cashier. In that case, he is having a dual role. That's it. But function wise, organization setup wise, both are different. Accountant is different from cashier. Accountant just records how the money has been spent. Okay, cashier is just performing transacting, that's all. He also not authorized to do on his own. Finance manager is there, treasurer will be there. He takes care of all these functions. Effect of that is being recorded in the accounting books. Okay, if you ask me what is the difference between these two, academically we have different, that's all. Accounting is a part of finance, we can say. Finance is a broader domain. See, management is having its own functional areas. Okay, human resource function, production function, marketing function. One of such functions is finance function. In finance function, you manage finance. While managing finance, we need to record how you are spending money, how you are receiving money, what you did with your money. Okay, or how the money has been received. That need to be recorded. That recording job is done by accounting. Of course, when the finance manager takes any decision, he may rely upon the data that is generated by accountant. So in that way, accounting is a subset of finance, we can say. Accounting is a subset of finance as a whole. Okay. You'll study in detail about financial management next semester. Any other questions regarding the discussions what we had last week? Okay, what is accounting? Huh? What is accounting? One at a time. Recording the transaction itself is accounting. Identifying the transactions and recording it. Okay, what is transaction here? One. Cash flow. If cash is not flowing, is it not a transaction? I am buying some raw material. I am a manufacturer. I am buying some raw material from my supplier. I did not give any money now. Is it not a transaction? Is there any cash flow in this? So cash flow is not necessary for having a transaction. Then what is a transaction? Mm-hmm. Okay. Transaction. Anybody? One, please. Yes, sir. Something you're telling? Buying and selling of what? Anything. Buying and selling of anything. Payment of salary is not a transaction. One by one will go, one by one. It is. So buying and selling is not alone the transaction. Buying and selling are the transactions, but they are not only transactions. Payment of salary is also there. Something you are telling, sir? That's what we are asking, exploring. What are the possibilities of financial activities? Financial activities are synonymous for transaction. We want to know what it is. That person is called transaction. Please understand the question, gentlemen. I am asking about what is meant by transaction. Somebody told, no, we are trying to explore what is meant by accounting. For that, somebody answered, sir, accounting is nothing but the process of identifying and recording transactions. We all know what is identifying. finding out, locating, recording. We may have some idea about it, writing something. But I want you to know what you are recording and what you are identifying. People are telling transaction. So I would like to make you understand what is transaction. This gentleman is telling buying and selling. Layman understanding, please have it. Layman understanding. What is the transaction? Yes, madam. Yes, madam. Exchange of goods, services. Okay. That's what he told, no, buying and selling. Okay, transaction is anything, define that anything. Flow of material, flow of service. One word we can bring it because it's too much, no? Business related transaction.
Exchange of something.
Okay, you are all having a fair idea about transaction. I will tell you what is transaction. All you told is correct. But we want some 2-3 words, that's all. We cannot remember all those things. It has some ambiguity in it. Okay, it is not a full-fledged one. Even
Sir,
one second. Yes, madam.
sir, I feel anything, any inflow or outflow can be transaction for the company.
Yeah. So anything or any economic activity that happens in the business which involves the transfer of money or money's worth. The second thing is missing in your definition. Money's worth, or you are telling in different context. Two are told in different point of view, but put together. Transaction refers to the economic event. Any economic event that happens in the business which involves transfer of money or money's worth. Money's worth. That's called transaction. Now we come back to the accounting definition. Accounting is nothing but the process of. You want to see from the slide? I have something for you. Yeah, before we define accounting, look at this slide. This is what we are talking about so far. Economic events. Transactions are nothing but economic events that happen in the business which affect the exchange of money or money's worth. In my case, I told you I taken goods from my supplier on promise, on a contract. I'll pay you later. I did not pay money immediately. So that's also a transaction because I am owing to my supplier that much of money in future. I have to give back. Okay, payment of salary. It's not just buying and selling of anything. I am meeting out my obligations to my employees. I'm paying salary to my employees. Okay, or buying of goods by paying cash, selling of goods without even collecting money from my customer, or selling goods by collecting money. So those things are called as economic events. That economic events are identified, recorded, summarized, classified, results are found out, interpreting such results, communicating that results to needy people. All those things we can call it as accounting process. The process is giving output. Engineers, you may know, input, output, input, process, then output. Logic. So inputs are economic event, that is transactions. Say for example, buying of goods, selling of goods, payment of salary. Okay, then this is being processed. Whenever it is happening, it is being processed through some set of books of accounts by following certain principles, by following certain set of rules and regulations. But in general, it is being processed. If you want to process something, we should have some predetermined standard rules. We'll talk about that little later. Okay, so it is being processed. After being processing, we come to know the result of the process. We come to know the result of the input. Okay, that input is being processed. It gives output or result. That output or result is being communicated to the users of accounting information. Who may be the users of accounting information? The business itself, the owner, lender, potential investor, students like you, academicians like me to know about the company, government, any other people. Okay, so such things are communicated. Then the owners or any other people are taking some decisions. If a bank wants to give loan, that also needs this information. They're external people. They were just wanted to know about these companies' performance in the last few years, so that they can take a decision: should I give the loan or not? Internal people, the management itself, would like to know how much profit the company has earned. What I'm going to do this profit? I'm going to invest in again one more unit, or I'm going to give back to my investors as returns, dividend, profit sharing. Okay, so these kind of things are going to be taken as a decision by the internal people as well as external people. So again, events are happening. So this is a cyclical event. Okay, it's a cycle, accounting cycle. Now come to the meaning. Now you know the logic of accounting, right? Yeah, look at this meaning of accounting. Accounting refers to the process of identifying, recording, classifying, summarizing the economic events or financial transaction. Both are same. Financial transaction or economic events, both are one and the same. Don't confuse yourself. It's very simple logic. Anything which happens in the company that results in transfer of money immediately or transfer of money's worth, that's called financial transaction. Okay. Appointment of HR manager. Is it a financial transaction or not? Payment of salary to HR manager is a transaction. Appointment of receiving application, conducting interview, giving appointment order are not the economic events. Okay. So that we need not record. Today we conducted interview. No. In interview you selected, okay, that also not recorded. For conducting interview, how much is spent? That need to be recorded. Okay. So after recording, what are we doing? We are preparing financial reports. Look at these transactions which are in terms of money or money's worth. Here it is money means it includes money's worth also. It's not just a transfer of money I'm talking about, which is having in the nature of money, in terms of money, which can be measurable in terms of money. Appointment of HR manager cannot be measured in terms of money. After 1 month over, HR manager is coming and standing in a queue to receive his salary. That time it is a monetary transaction. We have to pay money. If you are paying money also, monetary transaction, you are telling to HR manager, sir, today there is no salary, come next week you are going to give salary. That time also it is a monetary transaction because you are due to him. 1 lakh rupees salary means you are due 1 lakh rupees to him. Yes. Yeah, I will tell you. That is HR department will take care of that. Come next week. But accounts department should write. Yeah, if he comes next week, how much you are going to pay, how to record. We'll talk about that. Recording. We'll come to recording. We'll come to recording a few minutes later. Okay. Right. So after recording that, we are preparing some statements or we are preparing some financial report. Last week I told you, two statements. What are they? Balance sheet and statement of profit and loss. Those statements are prepared. Okay. After preparing that, there are some data in those reports that being analyzed and interpreted, and then you are informing those information to the needy people for guiding them in taking a informed decision. Is it clear? Accounting. Accounting is a process of identifying, recording, classifying, summarizing the financial transaction which are in the characteristics of money terms, and that is being, found out the result also analyzed, interpreted, and the information is communicated. Okay, it's a very process. It's very much it's a sequential process. Okay, in the next slide you can see that definition and all. You can read it later on. Okay, bookkeeping. There's a concept called bookkeeping. Just recording is called bookkeeping. Bookkeeping is a part of subcomponent of accounting. Accountancy means a broader discipline that gives the stipulation, that gives the rules and regulations, the guidelines. The broader framework is called accountancy. Based on broader framework, you are recording transactions. Okay, it's not that important. Just to have an idea. Bookkeeping is smaller. Accounting is little more bigger. Accountancy is still more bigger. Accountancy is guiding accounting and bookkeeping. Okay, accounting includes bookkeeping plus some other things. What are the some other things? Communicating, finding out the result, interpreting, analyzing, all those things comes after bookkeeping. Bookkeeping means only keeping the book, recording the transactions in the books of accounts. That's all. What are the books of accounts? How are you going to record? We will discuss a little later. Okay. Yeah, this I told you other day. Branches of accounting, cost accounting, financial accounting, and management accounting. Simply, so far what we discussed is a concept of financial accounting. Cost accounting deals with two things. One is the methods and techniques used to control the cost and ascertain the cost of a product or a service. Okay. Management accounting deals with those techniques, those tools which are available to analyze the financial data in order to get some meaningful insight about the company or a business to take some decision about the company. Management accounting is helping the management to take decisions based on some deeper insights that is being available based on the interpretation of data that is found in financial accounting. Okay, financial accounting ends with the two statements, starting from identification of financial transaction and ends with preparation of the two statements, recording, classifying, summarizing, finding out the result. These four are called as financial accounting. After these two reports are prepared, after these two financial statements are prepared, if you analyze the statement, what do you mean by analyzing the statement? Taking the data in the statement and try to find out the relationship between one data with another data, one variable with another variable, and finding out some deeper insight about the company. Based on that, if you take any decision, the all methods, tools, techniques, what are you using, that is called management accounting. Is it clear? Cost accounting, management accounting, and financial accounting. In academics, we have these three differently, but in practice, it will be going hand in hand. Okay, nothing can operate without the other one. All are interdependent, not independent. Okay. Okay, this I told you already. Objectives of accounting. The basic objective of accounting is, it is written there, so you're reading. I told you the other day, no, it's not of maintaining records. To know the financial performance, to know the financial position. Position means what? Don't tell story. Equity, liability, and asset. Financial position refers to these three. These three. Equity, liability, and asset. That's all. Don't tell anything more. Then financial performance refers to profit or loss. That's all. To knowing about these five things only, basic objective of accounting. How much is the liability of the company? How much is the asset of the company? How much is the equity of the company on that particular point of time? And what is the performance? How much is the profit or loss of the company? Only these things are the objectives of the accounting. Remaining all are ancillary objectives. Without I record anything, I cannot summarize. Without recording anything, I cannot know what is the asset. Today you are buying one asset. Tomorrow you are buying another asset. Another 6 months you are buying another asset. If you do not, or if you have not recorded these three things on the time of occurrence, at the end of the day, I may not be knowing how much asset is there in the company. So for that reason, we are recording. I want to know profit of the business. How do I know the profit? What is profit? Don't tell something. You have to tell correctly. What is profit? Don't. If I ask you profit, you have to tell what is profit. That's what we decided and finalized last week. No, income over expenditure. You have some perception on all the concepts what we are discussing. I am not going to tell you anything new for you. All these things you might have heard somewhere or other, but you might have some perception about that. You have to forget that, or you have to connect what I am saying with that. Profit is nothing but excess of income over expenditure. Income is not happening for a business at one point in time. Income is happening over a period of time. Over a period of time. These two things are going to be achieved by the accountant on a single day. But for that, we need some input for all other days. Income. January month sales will be there. February month sales will be there. Over a period of time, sales are going to be there. So you have to accumulate all those sales. That is happening in recording, summarizing, or classifying. Okay, but at the fine day, I want how much is the total income and how much is the total expenditure. I just compare these two. If income is excess over expenditure, I will say profit. If it is other way around, I will say loss. So the basic objective of accounting is to know the result of the business. That is nothing but financial performance, or you can call it as profit or loss. And another objective of accounting is to know the financial position that refers to equity, liability, and assets. To reach out these two, I need to maintain some records. So that also become an objective of accounting. To maintain the proper books of accounts or the records of business transactions. And then if I do all these things, what is the benefit for me? If you read everything in accounting on the day of examination of accounting for manager, you are in your own company only. What's the use? You know everything, you read everything, but you are not turning up for the exam. Is there any use? Is there? Maybe you know accounting, that's okay, but somebody should be there to certify you know accounting. So that purpose is last one. You did everything, but what is the use for that? That you have to communicate to the needy people whenever they need. So that's another last objective. So these are the objectives of accounting. Any doubt up to now? This already we discussed. We're just doing a revision. Last class, when I was dictating the syllabus, I was talking about all these things. Users of accounting, to whom you have to communicate. You cannot go and ask somebody on the road, sir, please come. We have some records. Take and see this data. No use. We have to tell them who needs it. Okay, you are all coming here after admission, so I am telling what is accounting. I cannot catch hold of you on the road. I come here, I am telling you accounting. There's no use. Similar to that, internal users and external users are there. To those people, you have to communicate your accounting information. Who are they? The owners or proprietor. Okay, the owners are proprietors or maybe a partner or maybe a shareholder, depending upon the form of organization. Okay, and then management itself, and you have to communicate to your employees also. They are the stakeholders, right? Yes, sir. Anything wrong? Mistake? If any mistake is there, please let me know. I'll correct it. Something? Or anything you want to say to the class? Nothing. Okay, personal. Okay, leave it. Personal things need not to be disclosed. Yeah. External users, maybe trade creditors from whom you are buying goods on credit basis, and then people from whom you are borrowing money called financial creditors, bankers, okay, debenture holders, anybody. Then potential investors, they have money, they are looking for some companies. That time we have to communicate them. We are good. Look at this. These are all our performance. We don't invest in our company. Potential investor. Then consumers, those who are buying goods from you or taking service from you, should have some information about your company. And then tax authorities. Finally, we are in a country or in a setup where everything is taxed. Okay, now government of India is going to tax on your income, on your profit, both. On your income means nowadays GST, right? On your sales GST, on your income corporate tax you have to pay. For that purpose, they are also looking for your accounting data or financial data. Government for taking any kind of decisions, and then research scholars, people like you, students or anybody who does any project or any other research on the company's financial performance, also need some financial data. Okay. Auditors are only providing data, no? Okay, once again, who is auditor? Sir is telling one who checks the things are right or wrong. A teacher also checking your paper. I am checking. Am I auditor? No, right? Who is auditor? Any auditor here? You are auditor? Then you have to accept the definition. No, sir is telling. Maybe. Yeah, check. Yeah, yes, auditor. Yes, auditor is different. First, you have to define who is auditor. Then types of auditor. Yeah, competent authority, competent person, certified by the professional body, ICAI, Institute of Chartered Accountant of India. But question is not who is auditor. Auditor is providing data or taking data. Auditor only is generating data. Why, how, madam? How it is? No. Okay. Who are you now? Your auditor. You are giving data. No, that who are you? You are going to an auditor, right? That you refer to whom? Consumer. Who is that I?
Auditor who actually validates the data.
Sir, once again, sir. Sir, once again. Yeah? Company is going to an auditor and asking for what? Let her finish. Yes, madam. Continue. Company is going to an auditor and asking for what? Silent, silent. Completely wrong. Auditor is getting salary from whom? Company. There are two type of auditors: internal auditor and external auditor. Normally, the accountant we are talking about, no, that accountant is nothing but auditor only here. The accountant we are talking about, right? That accountant is nothing but auditor only. See, auditor is a person who has to certify at the last. Your balance sheet and the profit and loss account is prepared by the company. Company is just like a building. It cannot prepare. Somebody should prepare on behalf of the company. Company means what? Company is just a physical existence. It does not have any human life like us. Somebody should do that. Okay. After doing that, auditor should sign. To the best of my knowledge and belief, based on the documents provided to me, the books of account reveal the true and fair view. 1 second. Fair view. Then he has to sign. That signing can be done by a native auditor, like any individual, or maybe a firm, or maybe PwC or any other auditing firm. They are signing. Okay. You are giving a document on a fine day and asking for a signature from PwC. Will PwC is able to sign? No. So what PwC will do is, or KPMG or whatever auditing firm you are telling, what they will do is, from the beginning they will set all the things in your place. They will have some people in your company or in your company who are all there will be trained by them. Whatever they want. They study the Indian accounting framework. Based on the Indian accounting framework, what is expected from a company, they will set in your company, in ERP or maybe in any other form. They will set in. With that flow only, you are preparing your accounts only. The accountant or the person or the clerk or ERP, whatever you are employing, they do everything based on the guidelines given by KPMG or any other accounting firm, what you are employing, or an individual, SNCO or PNCO, whatever it is. Okay, they will give guidance. After everything is over, they will sign. So who is preparing now? They are only preparing. See, they are not doing it manually in your company, all the things, but they are stipulating everything what you have to do. Otherwise, they cannot sign on the fine day, last day. They cannot sit and check everything 365 days what took place in the company on a single day or 1 week or 1 month also. They cannot do it. So they are guiding you. They are called as competent auditors. Okay. In your company, they may employ somebody. It depends upon the contract. Or in your company, some MCOM or MBA or some BCom or somebody will be there. They will be trained by those people what and all to be done. So this is how auditor only generating the data. Auditing firm, see, you are going to auditing firm for some other reason, that is different. But in this context, you are preparing books of accounts, you don't know how to prepare. Because there are legal formalities are there. You cannot prepare on your own if you do not know the legal formalities. And even if you prepare on your own also, government wants that to be certified by competent auditor who is having a certificate from ICAI. For that reason, what you are doing, first itself you are going to them, you are having an agreement, so you are my auditor. Okay, you please guide us in our accounting process. We just follow what you are doing, what you are saying. But he will not say whatever he wants to say. He will consult with the client based on his requirement. They will prepare a framework. Then the accounting department will go on. They will generate the data. In that way, only auditor is coming into picture. He will do. No, what is the problem? If he does a mistake, what's the problem for you? 1 second, let him complete. You are talking about auditor. Yeah. You are asking, sir, will he do mistake or not? Yes, error is human. If he is a human, he will also commit a mistake. Yeah, what is the problem there? He is only responsible. Suppose I am telling anything wrong to you, I am only responsible. I am certifying in the accounts last statement. No, to my knowledge, to my knowledge and belief, based on the documents provided to me, whatever the profit and loss account and balance sheet is revealing the true and fair view. Suppose mistake. An example, you can tell me. You are telling you if he does some kind of wrong. What kind of wrong? Example. Example. We cannot calculate less tax, no. How can it calculate less tax? What tax it is? What tax it is? What tax it is? We are deviating from the main aspect. Let me just stop it because we don't have time much. Only one thing you can understand: if auditor does any mistake, he is the responsible. That's all. Okay, he is only responsible if anything is debated later, challenged later, either by the company or by the stakeholder. He is himself responsible to defend what he has done is correct. With that statement, we just conclude this issue. Come back to the main topic. Yeah. What is that? What is that? What is that? I don't understand. It's something I tell you. SEBI. What is that? Securities? SE. But you told something else, no? Securities and Exchange Board of India. Sorry, is talking about Securities and Exchange Board of India. Anybody has any idea about what he is asking? Okay, so much. Okay, anyway, no problem. Let us, 2 minutes we'll talk about this. Sorry? Yeah, we don't submit the financial statement to. Will you send your answer sheet to UGC? For that only who is there? Dayanathagar University is there. UGC is believing university. It has come here. It has checked everything. After believing it, yes, you are an university. You do whatever you want within this framework. It is given. License is given. Likewise, SEBI already inspected everything. What is SEBI? Securities and Exchange Board of India. It is the regulating agency in India to control or regulate the capital market in India. SEBI comes into picture only when you tap money from the common people. We 200 people join together and contribute money and do a business. SEBI does not bother about it. SEBI will not worry about it. You also need not tell to SEBI. You can do your business. Private limited company. When you are going to list your company in the stock exchanges, that time you have to get permission from Securities and Exchange Board of India. Okay, it verifies everything and it gives you a license for listing. You are getting listed in stock exchanges. While doing so, stock exchange is becoming a regulating authority for you now. First regulating is done by whom? Stock exchanges. So you are liable to submit your all financial data to whom? Stock exchanges, either NSE or BSE, where your stocks are listed. Paying means? Yeah, the auditor is preparing all these things. After signing by auditor is done, that is going to be given to stock exchanges. Only for your shares are traded there. For that reason, you are giving them. Sir, this is what we are. Last 1 year, this is what we are. Please take it. If anybody who comes and trades in my stock asks for any information, you please provide. For that reason, we are giving to them. It's compulsory. It's mandatory. And you should have in your website also, it should be there. Every year, you should be publishing your annual report in your own website, which includes your financial statement. That means P&L account and balance sheet. It's compulsory. If you are a listed company, if you are private limited company, nowhere SEBI comes into picture. Suppose you are not doing this, somebody complains to SEBI. You are not doing this. You are not publishing your data in your website, or you are not giving to ROC also. You are not giving to stock exchange also. That time, any one of the potential investor or existing investor or anybody for that matter complains to SEBI, SEBI comes into picture. Then SEBI will ask you. First, SEBI will not ask you. SEBI will ask the stock exchange. What is happening? Okay, I have given you permission for listing the companies by following certain principles. Are you following that or not? First, it will go there. Then it will come to you why you are not giving this data in the prescribed format. If it is not given, even you can be ordered to wind up your company. Consequences are there, legal consequences. Okay, so any other connected questions? SEBI is nothing but an organization in India which regulates the capital market of India. That's it. Okay, so now we understood what is accounting. So we have to record transactions, right? For recording, we should have some principles. We should have some guidelines. We should have some framework. We should have some kind of what you can say rules and regulations. All those things collectively called as principles of accounting. It includes concepts, conventions, postulates, and standards. Now today we are using this word called standard, Indian accounting standard. Each and every country will have its own accounting standard. What is standard actually? Standard means cross. That's a very important thing. Across, uniformity. Uniformity. Standard means everybody is doing something, but we are standardizing it, taking all the merits of all the people, okay, and ignoring demerits or any other drawback, and you're framing certain thing which is to be followed by everybody. So that's called standard. Similarly, we have something in accounting. Okay, people followed very many policies or very many principles according to their own requirement, depending upon the locality. Simple example. In Calcutta, Gujarat, or some other places, Diwali to Diwali, they will be having an accounting year. Previously, some time back, Diwali to Diwali, Dasara to Dasara, there will be an accounting year. Okay, in some other place, they will follow April 14 to next year, April 13 will be one accounting year. You want 12 months only? No, I am following 12 months. That's all over. It depends upon the people, but it creates confusion, right? Comparison is becoming illogical or difficult. So I want to make it uniformity. Here, uniformity is 12 months should be there, but from what to what is a problem. People are following different places in different pace. Okay, so we want to standardize it from 1st April of this year to 31st March of next year. Only you have to follow. Likewise, this is called periodicity concept. Periodicity or accounting period concept. Financial year concept. Likewise, we are having so many discrepancies in following. So we are bringing everything together and we are making a standard one that's called standard. Okay, but the standard is nothing new. Standard is nothing but something which is evolved from existing practice. In this standard also I'm telling you, accounting year, 12 months is common. But from what to what is determined, fixed. Okay, so those things are called as principles or postulates or kind of concepts, or you can call them as accounting standard. Now, each and every country also has this kind of standard. A country like India has different places and has different policy or usage or practice. We are bringing together and making one common accounting standard of India. Similarly, accounting standard of UK is there. Accounting standard of Australia is there. Now we are living in a globalized environment, right? Everybody can go to any country and invest, and any country people can come to India and invest in the market. To make it convenient of comparing or logic of comparing, we want to have uniformity across the globe. For that, we are following certain thing called as IFRS, International Financial Reporting Standards. International Financial Reporting Standards. It's nothing but the universally accept, not universally, majority of the countries accepted this standard, except USA. USA is having their own accounting standards. Up to certain period, we followed US standard only across the world. US have that mentality, right? Whatever they have, that should be followed by everybody. But in this accounting domain, it has little changed. Okay, it has its own accounting standards, but India and other countries have IFRS. In India, we are not just following IFRS, adopting, we are converging with IFRS. We don't take IFRS and just adopt it. Some countries are doing it. They don't want to even small comma or full stop also change. They just follow. Okay, sir, the body, international body set it, we follow it. But in India, we just different. That what we do is, we bring IFRS, we read, we try to understand how it is connecting to our country. Is there any change required? We change it and we'll follow. That's called INDAS. INDAS. Indian Accounting Standard. Indian Accounting Standard is nothing but the converged standards of IFRS. Converged standards of IFRS. Okay. For all these things, you say anything INDAS, you say, or you say something called UK standard, or you say United Nations of, USA standard, whatever you say. But there's some principle, basic principles are common. Standards are nothing but something standardized, that's all. But the basic things are common. What are those common things we are going to study here? This based on this only, accounting domain itself is developed. Okay, here and there maybe changes take place in the accounting standard, but it is the base according to which the domain of accounting is developed. Okay, what are those? There are two: concepts and conventions. Concepts, we have some concepts. Convention means by custom we follow certain things. That's called convention. Okay, let us see one by one. First one, business entity concept. Please understand, accounting is based on these principles only, these concepts and conventions only. We need some common guidelines. That guidelines have been evolved over a period of time. Even much before the country has developed, or even much before the accounting domain has separately come into picture. Okay, so business entity concept. What is business entity concept? For accountant, business is separate, businessman is separate. There should be a clear-cut distinction between business and business owner, businessman. Whatever businessman brings into business need to be recorded. Whatever business gives to businessman need to be recorded. So it's my business only, I'll take something. It's my business only, I contribute something. You contribute, you do. Accountant does not have anything to do so. But accountant will record it. He will not say, don't bring it or don't take it. That says not there with accountant. No right is there. Okay. So it need to be recorded. Whenever he contributes money, capital need to be recorded. Whenever he takes back some money from the business, that time also it to be recorded. So that you can identify the real profit or loss. Example. Listen, sir, gentlemen. Hello, sir. It's not personal of her. Personal of businessman she's talking. We can listen. Yeah, we can listen. Example.
He's going on a trip. He buys a car.
How do you know? That businessman is going on a trip. Yeah, tell me, example. Trip only? He is buying a car. So, money, where from he company's money. So that need to be recorded. If you are not recording, you are not following the business entity concept. Suppose he is buying car by spending his own money. That time we need not worry about it. That does not come under business entity concept. Altogether, he is a separate entity. He is doing something. His own personal accountant will be there, no? His wife or his spouse, they will take care of it. Second one, going concern concept. Going concern concept. Going concern concept means business is there forever. Business is expected to be there forever. In that basis, you have to record the books of accounts. Suppose you are borrowing money. On what basis you are borrowing? Sir, I will be there in the next week also. I will come and repay it. Going concern. Going concern means what? Men may come, men may go, but business remains forever. But sir, how do you say business remains forever? We are not telling business should remain forever. We are expecting business will be remaining forever. As an accountant, I am expecting my business will be there forever. If businessman wants to close it, let him close it. For that also I have books of account, I'll write it. That's all. Okay. Indebtedness is to be recorded. Indebtedness will come only when you have going concern concept. If you don't have going concern, indebtedness will not be possible. I'm giving you 10,000 rupees, believing that you will repay me after 2 months or 3 months, assuming that my business will be there. If my business itself is not there, how do you repay? You are able to repay, you are going to repay, but I'm not there. So that concept is called going concern concept. Next one, accrual concept. Very, very important concept in accounting. Accrual concept. Accrual means something which is happened, but you did not receive the benefit for that. Simple example, you are depositing money in the bank on 1/1/2022. 1 lakh rupee you are depositing in a fixed deposit. Am I okay up to now? 1 lakh rupee you are depositing. 10% rate of interest. Bank is having a policy. It will give you interest only twice in a year. 6 months once, it is going to give you interest. So first interest, when you will receive? When? 30th June. After 6 months, 30th June. Okay. How much you will receive? How much? 5,000. 5,000? How much? 5,000. 5,000 you will receive. You are closing your books of accounts. Are you able to understand this word? Closing your books of accounts. Meaning, you are finding out your profit or loss. You are finding out your financial position on a particular day. That's called closing the books of accounts. I stop. I pause for a second. I look back. Whatever I have done for 1 year. Profit or loss, financial position. I'll just come to know, then I'll continue. That's called closing the books of accounts. That's happening on 31st March every year. 31st March every year. Now, 31st March in my company, I am just calculating what is my total income, what is my total expenditure to know about my profit or loss. Did you receive any money from the bank as interest on 31st March in this case? No. But have you earned anything from the bank? How much you earned? 2,500 rupees you are eligible to get. Your money was used by the bank. For that, they promised they will give you 2,500, but their policy is giving once in 6 months. Your money is with bank. Now your 1 lakh has become 1 lakh 2,500. These 2,500, even though you did not receive in cash yet on that particular day, you are recording that as an income. That is called accrued interest. Accrued interest. Income earned, but not received. Similarly, opposite side. You have something to pay. Rent. You are paying once in a year rent. Already 3 months utilized. But you did not pay the rent. You are going to pay the rent on 31st December. Assume 12 lakhs for 1 year. How many months you already utilized the premises? 3 months. You have to pay rent for 3 months, 3 lakhs you have to pay. But you did not pay. You cannot just count that rent, no, zero. If you take that, you are ignoring the concept of accrual. You have to consider rent payable, how much? 3 lakhs. You have to add it in the expenditure side in order to find out the real profit of that year. If you do not do so, these two you are not considering. You are finding out some profit which is not real profit of that period of time. Even though you are going to receive that 2,500 in the next year, but the 2,500 is of this year. Similarly, the 3 lakh also. Okay. So this concept is called as accrual concept. Next one. Any doubt in this? Something you're raising hand? Somebody? Yeah.
If you are investing this money and you are expecting some losses, it could be get up in some losses.
No, bank, you are giving 1 lakh, then definitely you are getting money, no? Interest, right?
You are telling about a bank. If I'm investing in something else or
What that something in accounting, we cannot call that something. Something is very much problem in accounting. You would say something.
one project.
What again you are telling one project only, no? It's very common.
Digging up a petrol well. And I'm
Sir,
investing some 5 crores.
sir, please, participants, listen. Yeah. 1 lakh I have taken.
No, sir, I got good money. I'll invest some 10 crores in some petrol well. It is going on. I'm expected to get a very good profit. That is our forecast. But if I don't, get a profit on this one, but I've declared already, then
Anybody would like to answer? Sorry? Will it come under accrual concept? No, it won't. No. You are investing a business. You are starting another business. You are starting another business. That's all.
expecting a profit. So
You can expect. That is not accrual concept. No. Here we are not expecting, gentlemen. Please understand. Here we are not expecting. Contractual. It's a contract. There it is expectation. You may invest 100 crore rupees in a Gulf country on an oil well. It's a business. Actually, it's a business. That's not accrual concept. For recording in that business, we are following an accrual concept. That's all. Okay, investing in a business is not coming under accrual. It's an entity itself. The project itself is an entity. For that, one accountant will be there. He will be taking care of it. Whenever that kind of construction comes like this, he will record. Otherwise, no. Investing, he will write an entry for this. That's all. Okay. Investing is different from this one. Here it is depositing. Of course, investing only in a common sense, but that is starting a business. Expecting some profit in my business, I will not record anything. And again, one more thing is a convention. Look at this. Since you raised it, I will tell you. What is this? Conservatism. What is conservatism? What's the meaning of conservatism? Hello, gentlemen. What is the meaning of conservatism? Are you conservative or you? No idea. What about you? You are conservative or not? some way. What is conservatism then?
Saving resources.
Madam, 1 second. Your classmate is answering now. 1 second. Yeah. Saving for future plans. If you get a bonus, 50,000 rupees, don't go for iPhone. Go to a bank and invest. Okay, iPhone. Yeah, sorry, sir. FD, fixed deposit. You will deposit. That is conservatism, right? What is conservatism then? Looking the darker side of the life and preparing for it. Conservatism. Here, what I mean by conservatism means, same example, if I get any idea about I am going to get some money in the future, I will not record it. In this case, contractual case, I am recording. Suppose there is a case against your company, or you filed a case against somebody. In that, you are claiming 10 lakh rupees compensation. You know that for sure you are going to win the case. Even that time also, you don't write it 10 lakh rupees as income of that year. That's called conservatism. I look for something which is going to happen later. It's a loss means I record. Suppose somebody filed a case against you, some workman filed a case against you, claiming 1 lakh rupee compensation. Case is trialing in the court, not yet finalized. Okay, but you make a provision, you create 1 lakh rupee, because if the case is owned by that fellow, you have to give 1 lakh rupee. So that is what conservatism. Foresee, anticipating the loss, but don't foresee the profit. Profit is recorded only when it is confirmed, not just received. Received is later, confirmed. In this SBI case or deposit case, it's confirmed. Receiving is later. For sure it is confirmed. Contract is there. But in a legal suit, if it's in the court, there's no conformity. Okay, in that time, if you are a party to pay, you will record it. You will recognize it as a liability. If you are a party to receive, you will wait. Sir, wait, sir, let it come. After coming, we will write it. That is the concept of conservatism. Convention of conservatism. Come back to the next one. Money measurement concept. What is money measurement? Simple logic. Anything which is capable of measuring in terms of money only to be recorded in books of accounts. Sir, he is a very honest person, sir. If you keep 1 crore also in his table, he won't take it. All the cameras switch off also, he won't take it, sir. That much honest person. Can you write it in the books of accounts? Honesty of HR manager. No. Honesty, dedication. Sir, he will come to office 8:59 every day. Office starts by 9:30. He will come by 8:59 every day. Let him come. Let him come and sit and do whatever he wants. We don't write anything. Sir, he does not go to office even after 10 o'clock. Office hour ends by 6 o'clock. Very, very overtime dedicating to company. He does everything in home also, office work only. All those things we are appreciating. Okay, very good. Good employee. That's all. We don't write anything in the. Suppose HR manager decides this honesty need to be rewarded. The next year annual meet, he is going to get some reward. For that, anything company is spending, that need to be. Otherwise, non-monetary thing, anything is measurable in terms of money can be recorded. Otherwise, no. Next one, dual aspect concept. Very, very, very important concept here. Here only we have to bring debit and credit without fail. We have to study about that here. Dual aspect concept. Yes, sir. Dual aspect. Okay. Each and every transaction has its own 2 aspects in it. One is benefit giving, another one is benefit receiving. Say, for example, you are paying 2,000 rupees salary to your employee. What are the 2 aspects in it? Company receives benefit from the employee of labor hour. For that, it is compensating to the employee. So 2 aspects. Both the aspects need to be recorded. If you do so, that is called dual aspect concept. If you do so, that is also otherwise called as double entry bookkeeping. Double entry bookkeeping. Both the aspects of a transaction need to be recorded. First one, you should understand, each and every transaction has 2-fold effect in it. One is benefit giving, another one is benefit receiving. You don't just give money to anybody, or we don't get any money from anybody, just like that. For something given, we are receiving money. For something receiving, we are giving some money. Okay. In that way, both the aspects need to be recorded. If you record only one aspect of it, that is called single entry system, which we are not following nowadays. Okay, that is not scientific. Nobody accepts it. So we are following only double entry bookkeeping. Whenever I say accounting, that follows only double entry bookkeeping. Okay. Yeah.
Salary example, if you take for the dual aspect.
Yeah. No, for measuring only you are paying money, no. On measuring only you are paying 2000 rupees. He spent 1 month time with you in your office. That is time of 8 hours per day, 24 days in a month is equal to 2000 rupees. You are paying 2000 rupees. That's not entry, no. One statement paid 2000 rupees. We will discuss that little later now. He's talking about entry. In entry, 2 times. Okay, since he asked me salary account debit to cash account, you have to say. People are not understanding, leave it, no problem. Salary account debited to cash account. Salary is spent. Spent. Okay, we are getting his work. For that, you are paying money, compensating. Salary is compensation. What you are giving? Cash you are giving. So cash. You are enter. Okay. Likewise, each and every transaction now, two aspects in it. Both need to be recorded. Here, if you do not get any work from him and you're paying 2000 rupees, you cannot write salary. Mr. X is paid 2000 rupees. That time what you write? Mr. X account debit to cash 2000 rupees. Since X is your employee, you are not writing X name, you are writing salary. Okay, we will talk about this little later. Just understand every transaction has two aspects. Both the aspects need to be recorded. One is benefit receiving, another one is benefit giving. In the entry, both need to be recorded. What is entry, how to record, we will discuss little later. Okay. Next, accounting period concept, I already told you. Accounting period, 12 months period should be there. That is also nowadays from April to March. Legal aspect concept. What is legal aspect? We cannot write anything which is illegal. Okay, cost concept. Okay, cost
I have a
concept.
doubt.
Yeah, cost concept means we have to record the transaction only at the price for which you bought it or you sold it. Really, what is the cost for you? Suppose there is a land near to this piece of land worth rupees 50 crore, but you negotiated it for 45 crore. You bought it. What you would write in the books of accounts? 45 only you would write. So it is 50 crore worth. I'll write 50 crore. No. Similarly, you sold one land. You sold one land which is worth rupees only 1 lakh, but you sold it for 3 lakhs. How much you would write now? 3 lakhs. What is the actual cost for you, or what is the actual cost for other people against you? That need to be recorded. That's called cost concept. Forget about the market price. You have to think about what really you spent or you received for acquiring or for disposal. Okay, that's called cost concept. Matching concept means revenue of the company of the period should be matched with the income, expenditure of the company of that period. You have to connect this with the accounting period concept also. Matching means matching the revenue with expenditure, income and expenditure to find out the profit. While doing so, you have to match the revenue expenditure with the revenue income. What is revenue expenditure? The other class we discussed. I told you you are buying one machine for 10 lakh rupees, but you are not charging all the 10 lakh rupees as expenditure. You have to charge only a part, depreciation. So that is also coming under this concept called matching concept. Revenue income should be matched with revenue expenditure. What is revenue expenditure? Any expenditure that is spent by the company for the day-to-day activities of the company. Okay. Purchase of machine should not be added in the expenditure column. Similarly, income. Suppose Government of India is giving you some 5 crore because of your eco-friendly or environment-friendly some organization. They are giving you some grant, 5 crore rupees or 5 lakh rupees. That you should not add it in the income. It's a capital receipt. Suppose shareholder is investing money in your company, 1 crore is invested. That you cannot call it as a revenue. That's an investment. Though you are receiving money, it is not an income for you. So that way it is called realization concept. Last one, objective evidence concept. Very, very, very important concept. Somebody asked the question, sir, auditor does some mistake, what will happen? That comes under this. Objective evidence. Suppose auditor is telling, sir, 10,000 rupees, you are telling that money paid to porter. Auditor does not know porter is employed or not. Auditor wants one slip. That's all. Voucher. See, PWC, in the Satyam case, what happened? PwC was the auditor for Satyam, then Satyam, right? Remember Satyam case? What was the issue? What was the allegation on Satyam? Fake employees, 10,000 fake employees. 10,000 fake employees. Really, Ramalinga Raju was intelligent. 10,000 fake employees. Creation of fake employees not that easy. 10,000 fake employees, 10,000 account was created. 10,000 account salary was credited. In turn, that all money came to company again. It is not that easy. We are simply telling is criminal, but doing that is not that easy. Another allegation on Satyam was fake FD receipt. State Bank of India fake FD receipt was found in Satyam company's balance sheet. Who was audited? PricewaterhouseCoopers. PwC has given a certificate that everything is true and fair view. For that only, to my knowledge and belief. How they believed? Satyam has given receipt. State Bank of India receipt. Really, Satyam was having a deposit with SBI. They given a receipt. If they are having 100 receipt, they are supplying 500 receipt. 400 receipt, they faked it. So this is called faking is not objective evidence. Document is objective. You cannot create any transaction. You cannot do any entry in the books of accounts without any objective evidence, not just evidence. Objective, what is objective evidence? Sir, he was there, he was seeing the transaction. That is not objective evidence. There should be a document evidence. Sir, I paid 10,000 rupees for porter. Okay, no problem. Where is the evidence for that? Voucher should be there. Porter will not keep a receipt book. Sir, I'm giving you 10,000 rupees, give me receipt. He will not keep a book. What you have to do? You should keep a book. You write his name, phone number, address, and everything. You get his signature on the stamp if it is crossing that limit. That is called voucher. Receipt. You are giving money to Government of India for registering, or you are giving money to somebody. Okay, receipt, donation you are giving. You are telling, sir, I given donation. Okay, no problem. To whom you given? Where is the receipt? Receipt. That's called receipt. This is called voucher. Salary, accountants. Everything should be evidence. So evidence only important for recording anything in the books of account. If auditor is okay with that evidence, he will allow to write it. Otherwise, there will be audit objection. He will raise an objection. Sir, these are the payment you are making. Later on, it will come to me also. Don't make this kind of payment in cash. You make it in transfer. Check or demand draft or account transfer, you make it. For that, you create a receipt. Okay, like that, auditor will give advice. This advice will be taken by the company and they will follow it. That's why I'm telling you, auditor is already making the framework. Okay, so these are the various accounting concepts according to which the accounting books of the company to be recorded. Look at this side, convention. Disclosure means you have to disclose the material fact about the company in the financial statement. You cannot hide anything. Disclosure. Materiality means knowing about that or not knowing about that is going to affect my decision. That's called materiality. Materiality means significant. Significant. Next one, consistency. So last year I followed one method. This year I'm changing another method. Next year I'm going to another method. That's called inconsistency. You are allowed to follow any method of your choice based on the framework allowed by the Government of India. But while doing so, you cannot change it very often. Every now and then if you change, it gives confusion to the investors, confusion to the people who are using your accounting information. You have to follow some regularity or some kind of consistency. Last one, conservatism, I already told you. Okay, so these are the various concepts and conventions of accounting. Put together, all these things put together, we call it as generally accepted accounting principles. One level, next level, one stage further. First, people are following that. Now we are trying to find out some kind of uniformity. Generally accepted accounting principles. After that, we have this accounting standard. Each and every country, based on the gap, they will frame accounting standard. We followed it, but again we had a confusion because cross-country investments are possible nowadays. For that reason, we want uniform accounting practice across the world, across the globe. For that only we have international financial reporting standard. Okay, international financial reporting standard. International financial reporting standard. Now, in India, we just take international financial reporting standard and we just do some changes and we follow. That is called Ind AS. I already told you. Yeah. Can we directly come to the recording? These equations we discussed already in the last class. Resources are equal to claim. That means resources means assets available in the company. That's equal to claims of somebody. In a company, if there is 1 crore rupee, hard cash 1 crore rupee is there, means only one asset is there, 1 crore is there. That 1 crore is whose money? Somebody given to you, somebody given to the company. It may be a owner or it may be some lender. For them it is asset. For you it is liability. Somebody's claim on you. Somebody's claim on you. Liability means somebody else claim on your asset. So asset are always equal to liability and equity. Okay. So this equation we already know. Income minus expenditure is equal to profit or loss. This also we know. Capital expenditure and revenue expenditure. Just now I told you know. Capital expenditure means any expenditure that creates fixed asset. Is it clear? Fixed asset. Land, building, machine, etc. Okay. Revenue expenditure means buying of raw material, payment of salary, day-to-day activity. If you pay anything, that's called revenue expenditure. The depreciation is nothing but that part of the fixed asset which is going to be charged to the expenditure of that particular accounting year. It's called depreciation. You are buying one machine worth rupees 10 lakh. That can be used for 10 years. So every year the cost of machine is 1 lakh. That 1 lakh is called as depreciation. That need to be added in expenditure list to find out the total expenditure. That total can be minused from income to find out the profit of the company. Okay, directly we can come to the recording of transaction. Yeah. Yes. Listen very carefully. I actually don't want to tell this, but there is no other go. We have to talk about this. Listen for 1 minute very carefully. The entire objective is to prepare 2 statements. What are they? Okay. In that, income, expenditure is there. Another one is liability, equity, and assets are there. So we cannot remember everything in our mind for 1 year period of time. For that, we are recording it. Okay. For recording, we have some rule. Okay, account. Okay, what is account actually? The financial relationship between 2 entities or 2 people or 2 different distinct entity. That's called account. Suppose you're going to a cafeteria. You're taking something and you're telling, sir, keep it in my account. You don't say. You won't say? You might have told. Okay. Here it's not possible. Maybe we are new. In our life, we might have used this word. Keep it in my account. Or sorry, your account is still pending. Somebody might have used this word. What do you mean by that? He will remember how much you have to pay and he has to ask you later, sir, this much is due from you, please pay. For that reference purpose, we need something to be recorded. Something to be recorded. So account we have to keep. What is account here? Heads of account. Only 5 accounts are there normally. What are the equity account, liability account, asset account, income account, expenditure account. These 5 common broad categories of account, heads of account. Equity. What is equity? The owner's claim in the business is called equity. Liability, how much the business has to pay to outsider is called liability. What is asset? What and all business owns asset. So under equity column, you may have so many subheading. How much really the owner contributed in the beginning? How much owner has earned in the business as profit? How much owner re-contributed, again contributed, second time contribution, third time contribution. All these things comes under equity account. Equity will increase when there is a profit. Equity will reduce when there is a loss. Equity will again increase whenever owner contributes further money. Equity will reduce whenever owner takes back money. But in company form of organization, owner is not allowed to take back any money. Owner is not allowed to give any money at any point in time. Okay. Next, asset. Under asset, we have 2 categories. Current asset, fixed asset or non-current asset. And you have so many subheading on that, depending upon your company: land, building, machine, car, equipment, computer, furniture, etc. It comes under which account? Which account? Which account? Non-current asset, fixed asset. What is that? Did you use that word tangible so far? Yeah, tangible may be part of fixed asset. Patent you are receiving from Government of India, or you are buying a patent from somebody. Patent. Copyright you are buying, copyright. Intangible. But it's a fixed asset. Long-term asset, non-current asset. Non-current asset can be of two types: tangible, intangible. That's it. Next, current asset can be there: goods, cash, etc. Okay. Come to another one: liability. Liability. Your supplier is your liability. Supplier. You taken goods on credit basis. Okay. Or your bank is your liability, to whom you have to pay money, from whom you taken loan. Okay. Likewise, come to income. Income can be selling of goods or any other receipt. Any other receipt. Expenditure may be buying of raw material and then payment of salary, etc. etc. So these are all comes under these 5 category. Okay. Now this 5 category is going to be broadly classified into 2 category based on accounting principle. One is real account. Okay. One is personal account, and one is impersonal account. Personal and impersonal. Any account that deals with natural and artificial person is called as personal account. Ram, a supplier for you. You are buying goods from him. Ram is a personal account. Bank, SBI, you are going and depositing money. SBI is a personal account. Personal account refers to those natural and artificial person. SBI is an artificial person. Dayananda Sagar University is an artificial person. ICICI Bank is an artificial person. Infosys, RIL, everything is called personal account, artificial person. But put together we call it as personal account. Other than personal, everything is called impersonal. In impersonal, we have 2 categories. One is real and one is nominal. Real means anything which is having some kind of physical existence. Existence. Okay, that's called real account. Really, it is there. Water bottle. It's a water bottle. I cannot say this is water bottle. People will laugh at me. So this is water bottle. People will laugh at me. This is called furniture or table. Table. More specific, table. In general category, furniture. So furniture is an example for real account. Water bottle is an example for real account. Okay. Then what is nominal? Nominal means you yourself, the accountant is naming on his own, on his discrepancy, on his whims and fancy, he is naming it. I am giving 10,000 rupees to my employee. What do you call that? Salary. Same 10,000 rupees I am giving to my landlord. You are changing your words. See? Same 10,000 only. Same 10,000 I am giving to one political party. What is it called? Fund. What is fund? What is it called?
Donation.
How can you give? That is why you are doing wrong thing. Political party, if you give, how it will become a crime? Government, if you give, it will be donation. 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 Charitable trust, you are giving donation. Same 10,000, but accountant is changing the name depending upon where it goes. If it goes to a political party, you are telling donation. If it is going to a employee, you are calling it a salary. If it is going to rent, landlord, you are telling rent. So different name. So this is called nominal. Namesake. The name is changing depending upon the purpose for which you are paying, or the purpose from which you are receiving. Suppose you are receiving money from bank account. What you will call? The 2,500 in our example. What is it called? Interest. Same 2,500 your customer is giving. What do you call? Sale. Sales, no? Sales. So receipt also, payment also, from which person or for what purpose you are receiving, the name changes. Those things are called as nominal account. These 3 account has its own rule. Now only the debit credit comes into picture. Before seeing that, I'll show you one small picture here. Is it visible fully? Yeah. This is what the entire accounting cycle. What is this? Identification of transactions. From where you will identify the transaction? From which you will identify the transaction? Evidences, documents. From documents, you will identify the transaction. In our ERP nowadays, it's popping up in your ERP. You will record it. Okay. From transaction, first we are recording in the books of journal or in the books of subsidiary books. Either journal or subsidiary books. Now, the account what we classified three category: personal, nominal, and real. These three are connected to journal. How are you going to make journal? Based on that rule only. Okay. If you do not follow journal, sir, journal is very tedious process. Journal is nothing but a single book. One book. You have to keep on recording all the transaction one after another, chronological order in the same book. Suppose in a single day there is 1,000 transactions. Can you record it fully? Huh? You have to, but can you? Will you be able to do? Yeah, I like that answer. No, sir. Okay. You cannot because 1,000 transactions, one single person, one single notebook. If you're writing, keep on writing, 1 week will over. Another 1 week, 7,000 more transactions will be pending. You have to write it. So for bigger companies, keeping a journal is very, very difficult. Those days, it was very difficult because manual accounting, right? Even today, if it is a computerized accounting also, it is difficult only. You have to record all the transactions in journal, again you have to go for next one. To avoid this process, what they have found out is division of labor. You might have understood, no? Division of labor in the OB. Division of labor means what? The entire work we are dividing into people. That is what we call it as subsidiary book. So total transaction we are writing in journal, only one book. Please divide the book into so many categories. Each and every group, let it go to one book. That's called subsidiary book. Say for example, sales book. Only sales will be recorded in the book. Only sales. Yeah, you understood, no? Purchase will be going for purchase. Sorry? Salary will be going to salary book. Is it so? No. If you do so, then 1,000 books will be there. Salary book, rent book, donation book, operations book, non-operations book. No, so many books. We don't want all those books. We categorize into few category. We are able to do it all the things in that category only. You are paying salary, right? You are paying. Three options are there. Only two options are there. Paying salary. What are they? Another one is account. For this, we maintain one book called cash book. Cash book. You pay anything for any purpose. If it is a check or hard cash, it will be recorded in only one book. That book is called cash book. Purpose no matter. To whom no matter. Only condition is if it is paid in hard cash or in check or draft or account transfer. For this purpose, bank account and cash both put together will be calling cash. But we have a column. Cash separate column. Bank account separate. So that book is called cash book. Clear? Purchase book will record only credit purchase of raw material. Two conditions are there for purchase book. Purchase book is a subsidiary book which avoids the creation of journal and which saves time. Okay, how? All credit purchase. What is credit purchase? On promise, on contract, without paying money. But another condition is that purchase should be of merchandise purchase. What is merchandise purchase? Purchase of machine is not a merchandise purchase. Merchandise means raw material, commodities, goods, stock, yeah, which is purchased for either reproducing it, processing it, or selling it. Suppose I am a water bottle vendor. I am buying 1 lakh water bottle. That can be recorded on purchase book. If I buy on credit. Suppose I paid money and I bought water bottle. Where I will record? Excellent. Cash book. That's it. Cash book. Similarly, if I sell goods to my customer, sell goods. Goods are called as merchandise in accounting. Merchandise. Okay, merchandise. Stock. Stock in trade. I am selling. On credit. Where I will record? Sales book. If I get immediately money. Sales is done, customer is paying immediately money. Where will record? Cash book. Here. Now 3 books are over. Sales book, purchase book, cash book. Majority of the transactions will come under these 3. Majority. In a business, what will happen? Paying and receiving money or selling and buying goods. Majority will come under this. Another thing, you are selling goods. Some customer, today we are talking about customer, what you can say, customer rights, right? Consumer protection, something. He's telling, sir, I asked a bottle which is having a small cap, but you given a big cap. Please take your water bottle back. What is that called? Returns. Returns. More specific, it is sales return. Return inwards. Return inwards. I have to keep a separate book for dealing with these kind of transactions. That's called sales return book or return inwards book. Inward. It is coming inward. Inward book. Okay. Similar to this. What I am going to keep this? I am going to give to my supplier from where I bought it. I can't do anything. No. I have to go and return it. So if I do so, I would record in some other book. That book is called purchase return book or return outwards book. How many books are over now? 5. 6th one. In business, credit basis are there. Credit. Okay. You are buying goods on credit basis. But the seller is not accepting your words. He wants some returns. Okay. He is writing something in a document and he is asking you to sign. So this much you bought, this much the value, you have to pay this much money on this date. He is writing, that's not invoice. Invoice is different. Invoice is for either cash sales or credit sales or credit purchase or cash purchase. Everything invoice nothing but in a colloquial term it's called bill. In a colloquial term, invoice is called as bill. Sir, give me a bill. Or they will ask you, sir, you want a bill or not? GST. You want bill or not? Sir, I don't want bill. No GST. Something like that. That's called invoice. After invoice is created, invoice is not a legal document for indebtedness. Invoice is a legal document for only transfer of goods, sales. Now, seller is creating one more document called bill of exchange. Bill of exchange, in which you will write all the details about the money, when you have to pay, where you have to pay, how you have to pay, all those things. He will ask you to sign. That document is called as bill of exchange. That's an evidence. Suppose you are not paying the money, he will take that bill to court of law. Or he can take the bill of exchange before you, the due date is there, you will go to the bank and he will discount the bill, he will get the money immediately. For that purpose, bill of exchange is created. Okay, for you, it is bills payable. You have to pay. For him, it is receivable. He will write one book called bills receivable book. You will write in another book called bills payable book. Your customer also may be there like this. He will have to create a document for them, bill of exchange. They will sign and give back to you. For you, it is bills receivable. So these 2 books.
Then for him, it is a sales credit. That only will go.
It's not sales credit book. While selling, he will write it in sales book. Matter over. If he wants double, another kind of guarantee, another kind of evidence, that itself is okay. It's a relationship between the customer and the supplier, right? You are a regular customer only, I will give credit for you. I will sell credit for you. That's okay. Suppose you are a new person or I want some evidence for that. I will create one more document. That's another transaction altogether. Whenever I sell goods on credit basis, I will record it in sales book, matter over. Addition to that, if I ask you to sign in a document, that document is called bill of exchange. For that, I will create one more book called bills receivable book. It is not compulsory. It depends upon the relationship between you and the supplier, customer and the supplier. And one more thing, one advantage is there for the supplier. What is the advantage? You can take the document, suppose it is worth for 1 lakh, you signed. I return on you, you sign and return back to me. 2 documents. One is with you, one is with me. Duplicate. 2 copies. I will take that copy to my bank and I can give to the bank. Sir, this is the copy given by so and so. He used to give me 1 lakh rupee on this date. You collect that 1 lakh rupee on that date. But you give me immediately some money. 98,000 you give me today. 2,000 rupees is your profit. You collect from him. If I do so, this is called bills discounting. What's the advantage now for me? I got the cash. I got the money credited in my bank account. I can use it. It's the working capital requirement is managed. For this reason also I will create this document. Not only about belief or contract, this purpose also I will create a document. So that document is recorded in separate book called bills receivable book. So how many books are over now? 7 book. Bills receivable and bills payable. Only one more. I understand there is a break time. Only one, no. Only one more. Now you tell me all the books, 8 books, covering some different group of transactions. If any transaction which cannot be covered under these 8 books, we have to record only in journal. Now, journal is going to be maintained, but the possibility of recording in journal is very, very less because everything is already grouped into 8 category. Example, selling of machine on credit, selling of old machine on credit to somebody. Where you will record now? Can you record it in cash book? No. Why? It's not a cash transaction. Can you record it in sales book? Why? It is not a product sale. It's a old machine sold. So where you will record? We cannot record anywhere in the 8 books. We have to believe on journal. But possibility of this kind of transaction in a company is every day it will happen. Every day we will dismantle one machine and sell it. Once in a while, 10 years once, 15 years once, maybe possible. So those transactions which are not eligible to, which are not possible to enter in any one of these subsidiary books called sales book, purchase book, cash book, purchase return book, sales return book, bills receivable book and bills payable book will be recorded in journal. But that time the journal is called as journal proper. That time the journal is called journal proper. Journal proper. Not just journal, journal proper. Just to show the difference between normal people are maintaining and along with subsidiary books you are maintaining journal. Okay, it's time for break now. Overdue. Okay, overdue. Okay, we'll take 5 minutes break. Okay, let us not waste the time on negotiation. We'll utilize 5 minutes break, 5 minutes, some other grace time, 10 minutes, come back. 3:30. Okay, you come by 3:30. Oh no, what's the time now? Come back as soon as you finish your coffee. Online people, there is a break. We'll meet after 10 minutes.
Okay.
Sir, we are unable to hear you. Sir, we are unable to hear you.
Yeah, I think they are not yet back.
They can unmute me also. Mute me, I unmute. No. We are waiting for another 2-3 minutes for your friends joining back. Then we'll start. By the time online people also, if you have anything to ask, you can ask me. Just we are discussing.
Sir, I have doubt with respect to accrual concept and dual aspect. So,
Yeah.
what is the exact difference between? Because as per my understanding, suppose if we take example of insurance, right? In that we'll have option of getting this money back policy. So, in actually both the cases, we will get
Yeah.
the cash, right?
Yep.
So,
Please come again. I'm so sorry. Please come again.
see, I want to know the difference between this accrual concept and the dual aspect concept. Okay, suppose if you are taking the example as a insurance, in that we'll get money back policy, right? So money back policy means we'll be getting some amount on the monthly basis or the quarterly basis, depends on that. So if you actually consider this case, so in actually both accrual as well as dual aspect concept is same, right? I'm just trying to understand. Did you get my question?
Yeah, I got it. I'm just trying to get your friends' attention also to your question.
Okay.
Once again, you tell him he will be getting it. He told 2 times. You will listen. Okay, those are inside the hall. Break is over. Still, if a break is there, you can make a break outside. Some serious question that Nicola was asking. He is connecting the insurance policy and dual aspect as well as accrual concept.
Sir, your voice is very low. I cannot hear properly.
I'll take the mic. Yeah. So he was asking about 3 things: dual aspect concept, and then accrual concept, and insurance money back policy. Dual aspect concept is omnipresent in accounting. Without dual aspect concept, you cannot make accounting. There is nothing this transaction or that transaction, nothing. Every transaction has twofold effect, and both the effect need to be recorded. That's the dual aspect concept. Accrual concept, of course, it's also without that we cannot make accounting, but all the transaction need not to be based on accrual concept. Money back policy, you are getting money from the insurance company after 4 years or 5 years. That is not a accrual concept, or that is not a concept of accrual actually. You are getting money after 5 years means you're recording it, that's all. And again, insurance policy in business, we will not make any money back policy. What policy will make? Suppose if a sole trading business, term plan for the sole trader may be made. Partnership also, term plan. You all know the term plan and endowment plan. If you are not taking insurance policy so far, please take one. Thanks for that gentleman raising that question. Out of the syllabus, you make one policy. You create, immediately take one policy if you are not having a insurance policy so far. That too, term policy. Any insurance advisors here? Or anybody working in insurance companies? Yeah. He may be, they may be better person to talk about this. Yeah. So, but they won't tell. If insurance advisors are there, they don't tell endowment policy is not better than
Your voice is
term
going
policy.
up.
Still, am I not audible?
Yeah, yeah. Actually, now it's audible. Maybe I think.
Okay. I'm just explaining. Dual aspect concept is omnipresent in all the transactions. We cannot make any entry without dual aspect concept. Okay, dual aspect. Any transaction has 2 aspects in it, so we have to record both aspects. We are going to discuss in another few minutes about that in practical. Okay, but in the case of accrual concept, some transaction which may be not resulting in money immediately, but it is going to give you money later, but that money is due for current year. That money is of current year. So you have to record those money which is not even actually received in the current year, but it is of current year means you have to record in the current year only. For that example only I told you the fixed deposit example. In money back policy, actually, it is not accrual concept. Whenever you are receiving money, you are recording it. That's all. How do you record the policy? You remind me when we are coming to the journal. I'll explain a little more further on this. Just one point on this, I'll tell you. Money back policy, whenever you receive money, we'll record it. That's all. It's not a accrual concept. Whenever you are receiving money, maybe 4 years once or 5 years once, there will be a 20% sum assured or 15% sum assured will come back to you. Whenever you receive money, you'll record it. That's a normal accounting procedure. But normally in a business organization, people may not be going for a policy of money back. Money back is normally for people like you and me, individual. Okay, so who needs money in between. Okay, but insurance, if we take insurance, is a product of risk mitigation. It is not a saving product. It is not an investment product. Myth is there in the market. But we people, India, what we believe, I pay 2 rupees to you, at least you have to give back 2 rupees. That policy, that mindset is there in Indian culture. Insurance is a purely risk mitigation tool. You pay insurance premium, don't expect anything return for you if you are alive. If you are alive. If you are dead, if you are no more, if the X is no more, if X is no more, Mrs. X or the family of X or the spouse of X should get benefit. That's it. That's the concept of insurance. Term policy is the best thing you have to. Term policy is only insurance policy. Remaining are I don't accept the endowment policy as an insurance policy. It's not insurance. As I think we are deviating from subject. Just for a general understanding, I'm telling you. If you don't have term insurance policy, take one now. Immediately after the class, go to anyone insurance companies of anyone of your choice. One term insurance minimum of 1 crore is compulsory if you are in the age group of 25 to 30. Okay, you have to take well in advance in the lesser age group so that your premium will be less. Other counter argument for this, somebody will tell, if you take in the lesser age, you have to pay longer period of time. But your life is covered that period of time. No? Yeah. So we'll talk about that, gentlemen. Accrual concept and in payback policy. We'll talk about that when I come to journal. I'll talk about journal entry by taking this as an example.
Okay, thank you, sir.
Yeah. Clear? Okay, now look at this. Continue. Journal or subsidiary books. Can you name the subsidiary books one by one now? Sales book, purchase return, sales return, bills receivable, bills payable, cash book, journal proper. Okay, these are all the various subsidiary books. Either, please listen, either to subsidiary books. Okay, stop talking. Either to subsidiary books or to journal. In a bigger companies, will follow subsidiary books. Where less number of transactions are there, you'll follow journal. But it is opposite in the class. We are not going to do this. We are going to do this. But this gives broader understanding of accounting itself. Here it is only a statement. Here there is no rule to be followed. Only we can make one small sheet of paper. All purchase on credit. We can write one by one according to date wise. If you total it, you will get total credit purchase. Please understand. Total credit purchase can be revealed from which book? Purchase book. If you want total purchase, total of purchase book plus cash purchases to be extracted from cash book. These two things put together, we can understand how much is the total purchase in that particular year. That can be done in ledger. Purchase ledger. So what is purchase ledger? Purchase ledger is nothing but the total of purchase book plus the various purchases made by the company by paying cash, which can be found in cash book. We have to bring, we have to collect. That is what we call it as summarizing. Remember now? Summarizing. Okay. Similarly, rent. There is no rent book. Where you will find rent? Only in cash book. Yeah, we can pay only in cash only. No, we cannot pay credit rent or check. Both will be there in the cash book. So we have to collect all those rent entry in the cash book. Prepare a separate ledger. That ledger is called rent account ledger, rent ledger, or simply rent account. When I say account, it's a ledger. Ledger is nothing but summary of one particular item of account. How much rent I paid, I cannot come to know from any of this. I have to come to know only from ledger account, rent ledger. Okay, salary, same. Okay, and then any kind of things, any kind of. Yes, sir. Anything important? You show me also, no? Hey, I also enjoy. No, no, later. Okay, not to me, for him later. Yeah. So ledger account. After ledger account is done, so many ledger will be there, no? Depending upon how many transactions are based on what nature of transaction, that many ledger will be there. Sales ledger will be there, purchase ledger will be there, rent ledger, salary ledger, return outward ledger, return inward ledger, many, depending upon how many items you are transacting in your business. Okay. After doing that, we have to collect all those ledger account balances. I'm using the word balances. What is balances? Suppose there is no counter entry or there is no opposite entry, there is no opposite side entry, the total of that ledger is called balance. Suppose you paid 12 months, 1,000 rupees as rent, total of rent account will be 12,000. That's called balance. Yeah, I'll tell you. I'll tell you. Suppose there is a person called Ramesh. Ramesh. Okay. Can anyone help me in typing? Anybody knows? Yeah. Open one Excel sheet and type what I'm saying. That is the problem for me. Yeah, you can minimize this. You can share that Excel sheet. We can learn what is ledger and how that ledger is having two sides of it and how do we balance the ledger. Okay. Possible? Yeah, one Excel sheet, yes. And share it also. Online people, can you see the Excel sheet now? Yeah, not it. 1 second. It will be. Yeah. See, say for example, by the time he is helping us, assume there is a customer called Ram. Okay, we are selling goods to Ram. 1 lakh rupee worth of goods we invoiced on him. He bought from us. He did not pay money to us now. So now Ram is indebted to us 1 lakh rupee. Where you will record this first? Sales ledger. Sorry, sales book. Sales book. In sales book, we record it. In the name of Ram, 1 lakh rupee. Ram is now debtor for us. Understand the word? Debtor. Debtor means what? The customer from whom we have to collect money or to whom we sold goods on credit basis. It's called debtor. He has to give us 1 lakh rupee. Sales book says only sales. Like Ram, Raj, Ibrahim, Anthony, so many people will be there. But we want to know how much we have to collect it from each and every person. Ram, Rahim, Abdullah, something like that. We have to know. For that, you have to prepare a separate ledger. That ledger, no. Bills receivable, I'm not telling about bills receivable, no. We sold it, we believe him, that's all. Bill of exchange is not created. Just is in the sales, that's all. Okay. We don't want to create any bill of exchange. To make simple. Now, after 2 months or after 2 weeks, he's coming and giving you 20,000 rupees. Sir, take 20,000 rupees. So now how much he has to give? Only 80,000. So these need to be tracked separately, right? How much sales is made is tracked in sales book, credit sales. Okay. How much total sales tracked in sales ledger. But how much is to be collected from each and every customer and how much is to be paid to each and every supplier? That need to be tracked separately. That is what we call it as debtors ledger, creditors ledger. Debtors ledger will have individual name, Ram account, Joseph account, Ravi account, like that. There are so many accounts who are our customer. Similarly, credit ledger will have supplier's name. Okay, now we are creating one ledger called Ram. Okay, so take first column date, A1 date. Those who are online, can you see the Excel sheet on the screen?
No, sir.
No, sir, it is the PDF that you're sharing.
Yeah. Yeah, Excel sheet is there. Yeah, book 1. Book 1. Yeah. Yes. Share it. Yeah, share. Yeah. All right. Thank you. Yeah. Is it visible?
Yes, sir. Now it's visible.
Fine.
Yes.
Date particulars. Date particulars. JF number. JF number. What is the JF number? Journal folio number. If you are not following subsidiary book system, this might have been entered in journal. In which page number it is entered, that page number you are going to write it in this column called JF number. Okay, JF number. JF number. Okay, next amount. Ledger folio number. Sorry, journal folio number. Journal JF journal folio number. Just a page number. Assume page number.
Sir, is
Of
this the
that,
journal entry, sir?
it is a ledger account format I'm talking about.
Okay, sir.
Yeah. Next. Sorry. Please don't confuse me. I'm already confused. Okay. Listen some time, then later you can say, tell this account is true or correct. Okay. Amount. One more amount. Quickly, sir. Yeah. Amount, one more amount. Column. Same thing. Copy and paste it from the next F. Yeah. Same thing. Fully. Date, particulars, JF number, amount. From F column. You can copy. Yeah. Amount. Yeah. Can you add one more row top? One more row top. Row. Yeah. Add one row. Okay. So this is the format of ledger account. Now which ledger we are preparing? ROM, a customer. Okay. On the top you write merge all the cell from A to J, merge it. Yeah. Right there, ROM account in the center. Central element, ROM account. So like this, you have to create account for each and every customer and each and every supplier also. But the process is same. I'll explain with customer, you can understand with supplier also. Okay. Now ROM account. Yeah. Yes. Fine. Very good. All right. Suppose assume on 1st January 2023 we sold it. 1 lakh rupee worth we sold it. Okay. Now if you are selling goods to any customer, we have to write it in the to my right side. To my right side. I mean first side. Date. In date column you write it 1/1/2023. No, don't write sold. Okay. Don't write sold. Listen now. If you are making a journal, first you have to make a journal, then you have to come here. Now I'm just telling you how both can be done simultaneously. If you're selling goods to Ram, Ram is what? Ram is a person, personal account. Goods is why real or nominal? Why confusion coming? It's real. Goods is real, right? Real. Sales means nominal. Same goods you're telling sales. Same goods you're telling purchase. So that time it becomes nominal. Okay. Now listen all of you carefully. To make journal, we have some 3 rules of accounting. People may call it as golden rule of accounting. I don't know golden or diamond, but there are 3 rules. We have 3 accounts now. What are they? Personal, real, nominal. Sir, can you just type somewhere, maybe in the down 19th cell, I mean 19th row, or anywhere, whichever is comfortable for you. Yeah. Personal account rule. Personal account rule. Personal account rule. Without that rule, we cannot make journal and we cannot make this ledger. Personal account rule. Debit what? So debit the receiver, credit the giver. Personal account rule. Debit the receiver, credit the giver. What is this, sir? Don't worry about this. Just understand now just memorize it now. I'll explain you by way of
Sir, your voice is muted. Sir, your voice is muted. Sir, we are unable to hear you. Sir, we are unable to hear you. Hello? Sir, we are unable to hear you. Hello, sir, we are unable to hear you.
Sir, if we're talking, we're not able to hear you.
Sir, from past 5 minutes, we are unable to hear you. Hello?
Yeah, they are inform that they are checking.
Account rule, debit the receiver, credit the giver. Next one, real account rule. Debit what comes in, credit what goes out. Again. Are you able to hear me? Online.
Yeah, now we are able to hear you. But from
I just repeat whatever you said.
A lot of noise.
Yeah. Am I audible now?
Yes, sir. Now we are able to hear you.
Using that mic, I think the charge is over.
Okay, I repeat whatever I was telling you in the before 5 minutes. We are talking about the rules for generalizing. Okay. I am about to tell you how a ledger can be prepared. For ledger, you have to make a journal. Without journal, you cannot prepare a ledger. So for that, I am talking about rules for generalizing. For rules for generalizing, we have 3 accounts actually. Based on the 3 accounts, we have 3 rules. Okay. Personal account rule. If a transaction is affecting a personal account, we have to follow this rule. If a transaction is affecting partly personal or another part is real, we have to follow both in a combination. I will tell you the example. Just you listen. So personal account rule says that debit the receiver, credit the giver. What is the receiver and giver? Who is benefit receiving? Who is giving the benefit? That's not receiver and giver. Okay. Debit, credit. It's nothing but plus minus or both sides of it. That's it. There's nothing important for this debit and credit. Okay. Next, real account rule says debit what comes in, credit what goes out of the business. Debit what comes inside the business. Okay, from business point of view, only you would look at the transactions. You are an accountant of a business. Don't confuse. You are accountant of a business. You have to look at from the business point of view. Third rule, nominal account rule says that debit all expenses and losses, credit all income and expenditure. Sorry, income and gains. Thank you. Income and gains. Income and gains. Okay. Income and gain need to be credited, expenditure and loss need to be debited. These 3 rules, golden rules of accounting and double entry bookkeeping rule. Now, sorry, can you now look at the journal? Just scroll down. Journal format also we can show to you. Yes. Scroll down. Yeah, scroll down. Next. Yeah, this is a journal format. This also you can keep it. Online people, you're able to hear me, right?
Yes, sir, we are able to hear. We are looking at the journal
Yes.
page now. Yeah.
Correct. So journal format, please copy this also. Ram account do it after this. Okay, just have it like this. Journal format. You remember I told you journal is a book in which all the transactions are to be recorded. If you are not following, subsidiary books. Okay, so date column is there, particulars columns are there, particulars column. Ledger folio number column is there, debit column, credit column. What is debit column, credit column? You are going to write the amount which is to be debited, which is to be credited based on that rule. Chronologically, you are writing this journal, one after another, 4, 5, 6, 7, date, like that you are writing. Okay, now, in our example, we sold goods to Ram for 1 lakh rupee. How do we write this journal? Ram, sorry, no? It's opposite, no? Ram is a person to whom we are selling. So Ram is coming under personal account. According to personal account, what's the rule? Debit the receiver. Who is receiving? Ram. So Ram account to be debited. So just you go to the Excel sheet. Share it and then make it share. Yeah. Write down. No, don't touch that. Take another one. Come down. Yeah, there you can write it. Just like that. 1/1/2023. 1/1/2023. This is journal. Just 1/1/2023. Date column. You already taken a format, right? Yes. Okay, in that 1/1 date column, you are writing 1/1/23. What is happening? Sales is happening. In particulars column, what I am writing is called entry. In the journal, date, particulars is there. In particulars column, whatever you are writing is called entry. The full is called journal entry. Right? Now we are making entry. For what? For a sale of goods to Mr. Ram. On credit basis. We didn't collect money. So, Ram is a person who is receiving the goods. So, Ram is a person. Personal account says that debit the receiver. So, I'm writing it here. Ram account. RAM, Ram, space A bar C. Account. A bar C. Small a, small c. Ram account. Okay. Account, we write short form. A bar C. Okay, come to the next line, sir. Next row. Yeah, next row. B column. Yeah. 2. Okay, listen here. Goods are going out. Actually, you have tried goods as personal account, real account. You have tried 2 goods account. But goods received also, goods given also, goods confusing. So the account is naming on his own. So whenever goods going out, we can call it as sales. Whenever goods coming in, we can call it as purchase. He is only naming it. He only is creating that name. So it's called nominal account. Nominal. It's coming under nominal category. Nominal category, what rule it is? Credit
all expenses or others, credit all incomes and gains.
Income. So 2 sales. Right, sir. 2 sales. TO2 sales. Okay. Write the amount 1 lakh. In 15C, you write 1 lakh. No, not 15C. 16D. Yeah, write 1 lakh. And 16D also write 1 lakh. Top also 1 lakh.
Top also 1 lakh.
Yeah, but this would be in E column. E16 and D15, right? D15.
Same.
Yeah, 1 lakh. D15.
How that?
1 lakh. Okay. This is what we calculate journal entry. Right? Come to the B17, sir. B17. Open bracket. Open bracket. Being goods sold to Mr. Ram. This is called small note on what is this transaction for. What is this entry for? Being good sold to Mr. Ram, or simply Ram. Being good sold to Ram, close the bracket. Yes, adjust we call it. Okay? Yes, sir. Yes, madam.
Both D and M, D and E are being named as Nama. How will I understand the debit and credit?
No, we told you to name it as debit and credit. No. No. Just to name your format, no. Debit and credit only I told you to name it.
Yeah, and here it is different.
Hide this. Hide this. Hide this. Yes. Okay, madam. Debit credit. That's all. It's journal. Okay?
There should be.
Can we do one more?
Yes.
Purchased goods from Rajesh. Purchased goods from Rajesh. For cash, rupees.
Purchase account.
Wait. Purchased goods from Mr. Rajesh for cash rupees 2 lakhs. 2 lakhs. This is a transaction. How do I know this? From invoice. That also from invoice only. Okay. Now, what entry we can make? Goods are coming in. So purchase account debit, nominal account, purchase account debit. Write it, sir. 2nd January. Leave one space. No. Leave one line. Yeah. 2/1/2023. You don't write this. You delete this. Purchase goods from Rajesh. They can write it. Only answer they can write here. Delete, just delete. Yeah. You will also delete. Okay. You want the column to be named there? Please name it, sir. Date column. A14. Date. P14. Particulars. C column. LF number. L capital, F capital, N capital, O small letter, LF number. Okay. Debit, credit. Debit, credit. Okay. Right, sir? Adjust 17 row. Adjust it. 17th row. Double click. 17. Yes. Yeah. Okay. Make your column also. You filled it, no? Okay. Now, what is the entry? Two. Why Rajesh? From Rajesh. But I told you purchased goods from Mr. Rajesh for cash. Meaning we paid cash. If we paid cash, what is going out? Cash is the real account. Real account rule says credit what? Credit what goes out. Cash going out. So two cash. Write it, sir. Purchase account debit. Purchase account debit.
I should mention here.
Yeah, purchase account debit. Two. Second line. No, don't write debit. DR only. DR. Okay, I'll do it. Is it visible now?
No, that's.
That's problem is
Tilted.
yes. Okay. Don't write debit DBIT, you can write DR. That's all. Okay. DR, debit. Credit we don't want to write. We simply leave it. It means credit only. The 2 is there, no? That specifics it is a credit. Purchase account debit. Next line 2 cash account. 2 cash account.
In bracket.
No. Just like the before. 2 cash. 2 cash account actually. 2 cash account. Okay. Is that understood?
Yes, sir.
No.
They sold it. It was wrong, sir. When we purchase it, why not the purchaser's name?
Sir is asking important question. When you are buying, we mention the name of the. Sorry, when we are selling, we mention the name of the seller.
Buyer.
I mean, sorry, buyer. But when we are buying, we are not mentioning the name of the supplier. Why? We paid cash.
Still you are paying to the same XYZ.
That is why the problem comes here. For what you are paying? If you paid on account, you have to mention his name. What does it mean? You are giving loan to him. You have to mention his name. Because you are going to buy get from him later. But now the person is not important. Why? You taken goods, you given money. That's all over. Why should you remember his name? If you want to know from whom you purchased for future purpose of sourcing your vendor, that will be there in the purchase book. Okay. Purchase register. That's not accounting book. That's a file. Invoice file will be there. Invoice will be kept in a separate file. In that file it will be there. Or if you want, you can write it in the narration also from whom he bought. But actually we don't want to mention his name. We don't worry about from whom he bought because he already paid cash. Accountant does not want. But who wants? Purchase manager may need of this data. He may be need of this data in future because he wants to know the supplier name, to place further orders or to analyze. For that purpose, supplier list will be there. That is not accounting book. That is not a accounting book. That is separate. For purchase function it is used. If you paid money, we need not remember his name. Why should we remember his name? If you want to give him in the future, that time only we remember. Why we are remembering Ram? We have to trace him and you have to get the money back. For that only we are remembering. He is an asset for us now. He is an asset, current asset. Money receivable, accounts receivable, debtor. That's why. Suppose goods sold to Mr. Ram for cash. A cash collected rupees 1 lakh. That time, cash account debit to sales. Ram is not required. Suppose Ram paid you check, collected check 1 lakh rupee and sold goods rupees 1 lakh. That time, bank account debit to sales. Check goes to bank. Our bank balance increases. That's right. Clear to you? Now go back to the ledger, sir. Hide that. Yeah. Sorry, sir? Yeah, like that you can write it. Being goods purchased from or being goods purchased for cash. You can write that. Being goods purchased, right, sir? Being goods purchased for cash. Within bracket, being goods purchased for cash. Being goods purchased for cash. 2 lakh rupees. 2 lakh rupees.
Where does this go? Purchase account.
Receive order credit.
2 lakh rupees.
Yeah, 1 lakh, 2 lakh, 2 lakh. In D19 write 2 lakhs and E20 write 2 lakhs. Top.
Okay.
Purchase account, nearby purchase account write 2 lakhs. One step above. Yeah.
Okay, and here I should like.
Correct.
What was the rule applied here?
Yeah, the rule applied here is nominal account and also real account. According to nominal account, debit all expenses. Debited. Purchase and expense, debited. Credit what goes out is the real account rule. Credit what goes out. What is going out? That's why it's credit. Yeah.
Sir, in the top,
Yeah.
the first one was personal account.
Yeah.
Applied.
Second one is nominal. Nominal. Okay, listen this. Purchased a plant by paying cash rupees 10 lakhs. Don't write it. Listen, you can write the entry there. There's another transaction. The business is buying a machine worth rupees 10 lakhs by paying cash. Now, which accounts are affected here? Machine account
Fixed asset.
is coming under
Real estate.
another account is affected as cash. Cash account is coming under asset. Nominal. I mean real. Okay. So in this case, both accounts are real only. We can apply just the real account. What real account rule says? Credit what goes out. Debit what comes in. Credit what goes out. What is coming in? Machine is coming in. What is going out? Cash. Machine account debit to cash. Right, it, sir. Third, one line leave it, then 23, yeah. 3rd January 2023. 3rd January 2023. You can write it, no? But you refers to you. Okay. Machine account debit 10 lakhs. Machine account debit, 10 lakh PR. Next lakh, 10 lakhs. 10 lakhs. To cash account, 10 lakhs. Being machine purchased for cash. Yeah, to cash. Next line. 24. Yeah, to cash. To cash. No, that's not narration. Being machine purchased for cash. Being machine purchased for cash. Can you connect this with your assignment? Okay? Right.
Here both are in real account.
Yes, exactly. In some time, combination of two accounts will be there. Sometime only one rule can be applied. It depends upon the nature of the transaction. Yes, sir. Anything? Yeah.
When you are doing that,
Please listen, all of you. Sir is asking something. Guys, listen.
when you are passing that entry, machine account data to cash account, are we writing credit or
no need?
Why?
No need. If you want to write, you can write it, no problem. But actually, we don't want to write. Credit side, amount is written, that shows it's credit. Again, 2 is there. 2 means it's credit side only. Okay. Normally, there is not something, there is no logic for that. There is no any rule for that. 2 I am writing. It's English actually. Debited to 2. In the English is coming. The sentence format. Ram account is debited to cash or sales. In that way it is. If you want, in modern days in ERP they are writing CR also there. Okay, in ERP they are writing CR also for specifying, later on it is just referring back, so CR also should be there. That's why they are writing, otherwise it's not required. CR, credit is not required. Okay, 2 is there means it's credit only. Okay, sir? Right, anything else? One more you can take?
Yes, sir.
You only tell me transaction.
Bill of entry. Bill of entry.
What is that? Bill of entry means?
Electricity bill paid.
No, how do you know what he is thinking? Please wait.
There is a customer.
Yeah.
I sold.
Yeah.
I sent the invoice.
Correct.
He did not pay me.
Yeah.
Before paying itself, there is a document which he
Wrong,
signs.
same wrong.
Yeah,
Wrong.
besides.
Bought goods from us. We are demanding a bill of exchange from you. Listen. Okay. We are asking Ram to sign a bill of exchange. We are asking Ram to sign a bill of exchange for the same amount of 1 lakh. You already sold to Ram. Goods sent, invoice sent. For that, listen madam, later we can discuss. Okay. For that entry is made. Now, next day you are calling Ram. Please Ram, come here. We have made one document in which you have to sign. That document is called bill of exchange. Okay. Now, he has come and signed it. One copy is taken, one copy is left in you only, the seller. For that, he is asking for entry. Okay. Now, bills receivable account debit to Ram account. Write it, sir. Bills receivable BR account. B bar R. Bills receivable account debit. Bills receivable account debit. Bills receivable account. Yeah, BR account debit to Ram account. Next line, to Ram account. DR only is enough. BR account DR. Yeah. To Ram account. Here also write debit.
What transaction is
I tell you. You don't know. What other transaction? Okay, sir. You only told no. You are asking Ram to sign a document. The document is called bill of exchange. He signed. Now he has given you money. That's the concept. He given you bill of exchange. So he is relieved from your ledger. He is relieved from you. Now you have one document called bill of exchange. That document will come and give you money. Suppose after 3 months he coming and giving you money 1 lakh. That time cash account 1 lakh debit to bills receivable account 1 lakh. Let us not go to that level now. I will explain this transaction first. You selling goods to Ram. That is the first one. 1/1/2003 over. But 4th January, you are calling Ram, sir, Ram, come here. You have to sign in this document. The document is called as a promissory note kind of thing. He is promising that I will give you 1 lakh rupee after 3 months or 2 months or 1 month, something like that. Where he is going to give, how he is going to give, everything he is giving in a writing. But actually, you only write it. You only create that in the name of Ram. Ram is asked to sign. He is signing and giving you 2 copies. One is with you, one is with him. For you, it is bills receivable. After 3 months, you are going to receive 1 lakh rupee from Ram. Otherwise, also you are going to receive from Ram. Even this transaction is not happening also, you are going to receive from Ram because of you sold goods to him. But an additional safety or additional something you are creating. If you do so, this entry will come. Writing a bill of exchange on Mr. Ram for the goods sold on 1st January. Now, nearly nothing is happening. Nearly nothing is happening. For that, you are creating a document, but that need to be accounted.
But 2 times account is happening.
No.
We have already passed 1 lakh.
2-time accounting is happening, not for same transaction. First one was for selling. This is for payment. Actually, this is payment actually. It's a kind of payment. If he is giving cash, what to do? Cash account debit to Ram. He is not giving cash. If he is giving bank, check, what will do? Bank account debit to Ram. If he is directly depositing money into your bank, what will you do? Bank account debit to Ram. He is not doing anything. He is simply keeping quiet. But you are disturbing him. Hey Ram, come here, sign here. For that, what you are doing? You are receiving one document. That document is having 1 lakh rupee value now. After he signs, it's signed like a Reserve Bank governor. Now he is having 1 lakh rupee worth in you. You can collect from him after 3 months. For that, you are receiving a document. But if you are going and discounting in a bank, you can get 98,000 like that. It's 2 transactions actually. That's why 2 entry. This is settlement actually. Now he settled his account. His account is no more. See, one there was a debit. Another there is a credit. You remember why he started? He was asking, sir, can you tell me the opposite side entry? Opposite side. So now go to the ledger account of Ram. Something is hidden, no? Top. Go there. Yeah. You written that?
No, hidden.
Yes. And write it. Now we can create Ram account. Ram account will have which balance now? How much balance will be there? 0. One side 1 lakh was there, another side 1 lakh is there now. Net effect is 0. This is what I was trying to explain how the account is balanced. Okay, right. Yes, sir. 1 second. Sorry?
We did not enter the last transaction.
Oh, yeah,
What is the amount? 1 lakh.
1 lakh.
This is for receiving bill of exchange from Ram.
Nominal.
Bill of exchange is a real account. Based on real account rule, debit what comes in, VR account debit. Based on personal account rule, who is giving it? Ram. Credit the giver. Ram account, credit it. Being VR received from Mr. Ram. Being bills receivable received from Mr. Ram. Slowly you can understand actually. Yes, sir. Yes, ma'am.
For the second one,
Sir, listen, please say something.
for the second one, you said purchased goods from Rajesh for cash.
Yes.
So which is going under the
2 accounts. One is
real account
and
the nominal account.
no, nominal and real.
Yeah, nominal and real account. So for the nominal account, the rule is you debit all the expenses and losses and you credit the incomes and gains. So shouldn't that 2 lakhs of purchase account go under the credit because
Purchase is a income or a expenditure?
it's a purchase, basically it's an expense
So expenditure should be
under debit.
debited.
Okay.
So you are paying money. 2 lakh rupees you are paying
Yeah.
to Mr. Rajesh.
Rajesh.
For what you are paying? For goods purchase you are paying.
Yeah.
What is going out? Cash going out. Cash comes under real account. So according to real account rule, credit what? Goes up.
Goes out.
So 2 cash.
So in both the cases, both are going out, right? What is
What the case means?
like if both the
Sir, please.
you said first we have two rules. First, also you have debited all the expenses and losses, which is basically your purchasing the account. So that is also a debit. And the second one, also two cash account when you are doing the real account rule, wherein you credit what goes out. That is also again this one is right. Money going out.
Yes, money going out. For what is money going out? For buying goods, money going out. You are misunderstanding the basic concept of two aspects. For each and every transaction, you have to write two aspects. One fine class like this, one engineer was asking the same question in a different way. So I purchased goods for only 2 lakhs. But you are writing purchase account debit 2 lakhs, to cash account 2 lakhs. Totally 4 lakhs are there. I bought goods only for 2 lakhs. Same things he is asking in a different way. That's all. Please understand. See, two things are there. One is you are getting goods. Yeah? For that, one entry should be done. Your language, one entry, one line. Purchase account debit. Another one is you are giving cash. Actually, it is two things happening in one time. You are giving something and you are taking something. Giving something is cash, credited. Taking something is goods, debited. Actually, goods account also can be debited. Goods account debit. Tail account rule. Goods account debit. I don't want to confuse you. Goods account debit sometime and goods account credit and some other time. I am not sure which is purchase, which is sales. So accountant is naming it. Whenever I get goods, purchase. Whenever I sell goods, it's called sales. That's why it's called nominal account. Each and every transaction, there should be a two aspect in it. Both need to be recorded. We are recording it. Goods account, I mean purchase account debit to cash account. Simple. Yes, sir. Go back to the ledger account. Yeah, now please allow me to listen very carefully. This is very important, ledger account. Now we are preparing ROM account. Okay? ROM account we are preparing. ROM. Wherever ROM is there in the journal, I have to refer those entry. I have to make it in ledger. Ledger is a format. Look at this. Ledger format. This is a ledger format. Okay? Ledger format. Whatever the name on the top, you have to write the name of the account. ROM account, Ravi account, cash account, bank account, capital account, whatever the account it is. Okay. Now, ROM, which is in the journal. Look at the journal. ROM account is in which side? ROM account is in debit. So, please write it here. A1, write it DR. A1. Okay, A1 is not possible. Put one more, 1, 2 in between, create one more line.
Here, na?
Yeah, no. Row 1 and row 2. In between that, create one more row. Yeah.
Okay.
Yes, create one more row. Yeah, now in A2, you write it DR, A2. Simply, no merge, no. A2. Come to A column, second row.
A2 cell.
A2
Okay, sorry.
You don't use that?
Okay, sorry, what should I mention here?
Yes, DR. Okay, sir. So this A, B, C, D and E, up to A, B, C, D, E column, it's called debit side. Okay, the remaining is called credit side. Go to J2, sir. Cell number J2, credit. Oh, no, don't merge it.
Don't merge it, okay.
Yeah, don't merge it. It will be there only. Or if you are merging also, no problem, but keep it to the left side only. Right? So this is debit side, this is credit side. Nowadays in ERP or any other modern software accounting, this debit credit does not have much importance. Okay, it's very simple actually. Plus, minus, or addition, subtraction, like that, opposite of that. Okay. Now, how I am making a ledger account of any person or any account? Look at this. Wherever in the journal this name is appearing, I have to refer. How many such individual unique names are there? That many ledger I have to prepare. Is it clear? In journal, you keep on entering in journal depending upon the number of transactions that took place in the business on the regular days. Okay. Once in a day, or once in 2 days, once, or once in a week, you can post the journal into ledger, those days. Nowadays, simultaneous. In ERP, simultaneous is happening. Okay, those days, per day or 3 days once or 4 days once, weekly once, they will do that. Okay, now we are going to post journal entries into ledger. Otherwise, you are preparing a ledger account. How many ledger account you have to prepare? How many unique names are there in the journal? That will ledger account I have to prepare. Say for example, sir, scroll down. RAM is there, sales is there, purchase, cash, BR. That's all. Only 5. Can you? Sorry. RAM, sales, purchase, cash, machine, BR. 6 account you have to prepare. Normally, we are not going to prepare now. Just assume 6 account you have to prepare. I'm telling you one. From that you can understand how to prepare all the ledger accounts. We are taking RAM account. Okay. So RAM is in which side on 1/1/2003? Debit side. So I have to go to debit side of RAM account. Go to ledger. Debit side of RAM account. This is called debit side, right? Debit side. DR is here. Debit side. Okay. I'm going here in particular column. I'm writing 2 sales. 2 sales. Why RAM account was debited? Because of sales. I made 2 him. 2 sales. Sales account. SALES account. You are troubling you much?
No.
Sales account. A bar C. Small a, small c. Yeah. A bar C. Okay. The general folio number we cannot write it. It's only academic purpose. We don't have real time. Some page number. So we ignore it. We just leave it blank. Come to amount column. 2 amount columns are there. Actually, plus minus something is required. We can write it. Otherwise, 1 amount column is enough. 1 amount column is enough. Okay. I'll go to second amount column and write the amount. Second amount column. Yeah. How much it is? 1 lakh. I write 1 lakh. Okay. Next. Second date, there is no RAM. Third date, there is no RAM. Come down. Scroll down. Fourth day, there is a RAM. Fourth day. RAM is which side? So I have to go to credit side of RAM account and write why for he was credited. I have the date first. Credit side. Credit side.
Okay, sorry.
Top. One more.
Okay, here.
Yes. By, you have to write by. See, by means receivable account. Date you write something.
I should write by.
That's it. CR is here. CR don't write. By BR account. Why BR account? It is there in the journal. Bills receivable account. Date is 4/1/2023. Double click. G column double click. Adjust it. Leave it. Okay. Amount. Second amount column related. Second amount column. How much it was? 1 lakh. Okay, sir. Delete the one amount column, sir. You are getting confused. I and D delete it. Possible?
So
Keep these separately.
maintain only one amount.
Yeah. Keep it one amount. Wait, sir. Don't delete it. He knows. Only one amount column we keep it. No problem. That's the purpose. No confusion. Otherwise, leave it. They will keep only one amount column. Okay. Now, it's okay, sir. Leave it. Come to the PDF. I have some work out there. We can see that what kind of writing. We can understand how it is. Gentlemen, leave it. Come to PDF. Yeah. Share the PDF. One point you have to make it here. 3 rules are there. Combination of these 2 rules are sometimes 3 rules. You have to make journal entry. If you make one journal entry with 1 debit and 1 credit, it is called simple journal entry. So far it is 1 debit, 1 credit. It's called simple journal. Simple. Sometimes 1 debit will be there, 2, 3, and vice versa. That is called compound journal entry. Say for example, sold goods to Mr. Ram for rupees 2 lakhs, for which 1 lakh cash received immediately. I repeat again. Sold goods to Mr. Ram for rupees 2 lakhs, invoice raised on draw 2 lakh rupees, for which 1 lakh rupee cash is received. First entry now, actually it's a 2 transaction. Sale of 1 lakh rupees for cash and sale of 1 lakh rupee on credit. But we can merge these two together and we can make it the same date. Same date means only we can do. Suppose 2 different dates are there means you cannot do. What is the entry now? Wrong account debit. 1 lakh. Cash account debit 1 lakh. To sales account credit 2 lakhs. This is what we call it as compound guarantee. We call it a signaling theory. We have something called signaling theory. Some signal is very strong from there, but I'm avoiding the signal. But this signal is sometimes coming, so I'm giving importance. Yeah, close, not close by. Rarely it is doing. So I thought really it is. Some movie will be released every month. That movie we don't worry. Some movie, once in a year will come. Will give importance. I gave importance, but it is not so. So listen. Yeah.
So that is basically one
single same day, one debit, 2 or more credit, or 2 or more debit, only one credit. If that is the case, no sir, I don't want to make one single entry. Compound entry I don't want to make. I want to make 2 entries. You can make no problem. Ram account debit to sales 1 lakh each. Ram account debit to sales 1 lakh each. Cash account debit to sales 1 lakh each. 2 entries. It saves time if you make only 1 entry. That's called compound entry. Yes, sir. Sir, can you please, go down. Yes, please. So this is a simple entry. What is this for? You are buying a furniture. You are buying furniture by spending rupees 15,000 rupees. Allah, look at this. Have you shared it? Online people are able to see the slide.
Yes, sir.
Yes, we can see the slide.
I can put this. Yeah, so we are buying a furniture. The company is buying a furniture for rupees 15,000 rupees by paying cash. So what's entry now? Furniture account debit to cash. What rule is applied here? Only one rule is applied. That is real account rule applied. Debit what comes in. Furniture has come in. So furniture account debited. Credit what goes out. Cash account. Cash gone out. So cash account credited. Being furniture purchased for cash. All of you okay with journal? Can you go to the next one, sir? Look at this. There are 2 people, Ravi and Raju. They are starting a business. First time. They are starting a business by contributing. Ravi is contributing 1 lakh rupee in cash. Raju is contributing one motor car worth rupees 60,000 and a furniture rupees 10,000 and also cash rupees 1 lakh. There are 2 people joining together and starting a business. Namely, Raju and Ravi. Raju contributes 3 things. Hard cash 1 lakh, motor car 60,000 rupees worth agreed upon by both of them, and 10,000 rupees worth of furniture. These 3 things who is giving? Raju is giving. Ravi is giving only 1 lakh. Now you are accountant, you have to start the business and you have to make entry. What's the entry? What and all comes in? Cash coming in?
Credit.
Furniture coming in? Motor car coming in. All these 3 things are real account. According to real account rule, debit what comes in. So one by one, cash account debit, motor car account debit, furniture account debit. No. Cash account debit, motor car account debit, furniture account debit. All are debit. That is wrongly written over there. Debit, credit. Okay. First column is debit, second column is credit. Right. Debit. Now, how much worth of assets are there in the business? 2,70,000. This 2,70,000 is contributed by 2 different people. One is contributing only 1 lakh, another one is contributing 1,70,000. So credit the giver, personal account rule. Who is giving? Ravi and Raju. If only one person is there, just you can write capital account. If only one person is there, you can write just capital account. No need of writing his name. Because only one owner is there. More than one owner is there means if you write capital, it confuses. Whose capital it is? You have to prefix his name. So Raju's capital account credit to Ravi's capital account credit, how much they brought in. Being business started with cash, furniture, and motor car. Is it clear? This is what we call it as compounding. More than one credit or more than one debit.
Is 2,70,000 rupees.
Yeah.
That Ravi is giving 1,70,000.
70, yes. No, Raju is giving 1,70,000.
Raju is 1,70,000. Ravi is
1 lakh. Okay, next one, please. Yeah. Something. It is there in your LMS, but just leave it down. There is explanation in it. It is there in the right? Sir, can you go to the next one, sir? Next. Yeah, look at this. Look at this. Very carefully look at this. Sumit started business with cash rupees 1 lakh. The first time they are starting a business, January 1st, 2023, Mr. Sumit is starting a business. The sole proprietorship organization. Only one owner is there. Sumit is starting a business. By investing
1 lakh.
cash rupees 1 lakh. So what's the entry? Capital. You are always doing ulta. Opposite. It is cash to capital.
Cash account to capital.
Yeah, that's a problem. That's a problem. That's why he's telling, sir, whatever I studied, you are telling opposite. You only don't know. Whatever you studied, it is different. Yeah, it's different. You told. It's not different, actually. You forget. When you study, become. Simple, sir. Rule is simple. No. Debit, what comes in? What is coming in? Cash account debit.
Cash.
Sumit is giving. So you write to Sumit's account only. But who is Sumit here? He is not just Sumit. He is proprietor. So it's capital. If more than one proprietor is there, you write S capital, T capital, X, Y capital. Next one, paid into bank. We want some. We want to have bank account no? To make any payment or receive any receipt. We need a bank account. Without bank account, we cannot do business. So he is paying into bank rupees. One class they asked me, sir, 1 lakh Sumit brought in, and this 60,000 again he is paying into bank. This 60 is out of this 1 lakh only. But in this class, one student was asking, sir, he is bringing one more 60,000 to pay into the bank. No, everything is about business. Only this is between business and the Sumit. Remaining all within the business. Okay, that usage you would understand. The business is paying. Sumit is nothing but business person. He is only paying. Out of this,
1 lakh.
1 lakh only, not a new 1 lakh, new 60,000.
What goods from Mohan?
We are into bank only now. We'll come to Mohan later. So paid into bank. Paid into bank. But the two account affected here, cash account is affected.
Bank account.
Yeah, bank account is affected. Bank account is a personal account. Cash is a real account. Personal account rule says debit the receiver. Who is receiving? Bank is receiving. So bank account debit to cash. Otherwise, simple understanding. Whenever you deposit into bank balance will increase, debit bank. Whenever you take money from bank or you are paying money from bank, credit the bank. Okay, you are getting SMS from a bank. Your bank account is debited. That and this will have opposite relationship. They are writing for you. They are not writing in their book. They are telling you your account is debited. Now, after Sumit is depositing 60,000 rupees in a bank, you will get a message stating that Mr. Sumit, your account so and so number has been credited with 60,000 rupees. But you are debiting bank. Don't confuse this. Bank is debiting cash, crediting Sumit. If suppose this entry is for bank, means bank is receiving money. For the cash account is real account rule says debit what comes in. So debit cash, they will write cash account debit to who is giving? Sumit is for them, Sumit is giving to Sumit account. Immediately after that, Sumit will get an SMS. Mr. Sumit, your account is credited. In their book. In their book, it is credited. You have to send a message, hey bank, your account is debited. Don't confuse with your salary credited or money credited or debited. It's having opposite relationship because of their book they are telling you. In their book, what is your status they are telling you. Clear? So now we come to bought goods from Mr. Mohan on credit. 20,000 rupees. What's the entry now?
Credit.
So goods are, I mean, purchase account debit to Mohan account. Purchase account debit to Mohan account. Why?
Mohan account.
Purchase is nominal account. Nominal account says debit the expenditure debited. Mohan is a personal. Personal account rule says credit the giver and debit the receiver. Now what we are doing? Bought goods from Mohan. We are buying goods from Mohan. Mohan is giving you goods. He is the giver. So purchase account debit to Mohan account. Being goods purchased from. Next one, what is that? Next one. You. Another you.
Bought goods purchase furniture and computer.
For how much?
Purchase furniture for 2,000.
2,000. Computer for
20,000.
20,000. Tell the entry. What do you want to do? 1 second, please tell me.
Furniture
Debit it's the personal account, right? So
Tell the entry. Furniture account debit 2,000. Computer account debit 20,000. To cash 22,000. Being computer and furniture purchase. Clear? Any doubt? Next slide. Scroll down. Right. That's over. No? Sold, sorry. Paid for postage. Simple. Postage account debit to cash. Postage paid. Sold goods for cash.
Cash account to sales.
Very good. Next. Sold goods on credit to Manish.
Manish account to sales.
Manish account debit to sales. Suppose it is like this. Sold goods to Manish for cash rupees 20,000. Cash account debit to sales account debit to cash account debit to Manish account. How sales account?
सब लोग बात कर रहे हैं.
Cash account to sales account.
Paid money, name is not required. If you did not pay the money or collect the money, name is important. Name is important. If you collected or paid, he need not to be remembered. I tell again. Goods purchased from Mr. Morgan for rupees 10,000.
Purchase account.
Yes, madam. Online, somebody is telling yes.
Purchase account to Manish account.
Purchase to
Definitely.
person from whom you are buying. Because we did not give any word there, cash, credit or something. If no word is there, cash, we assume it is a credit transaction. It's only for our understanding to make a uniformity. But in real life, it's very much clearly given the invoice, cash paid, it becomes a receipt. Or a credit invoice that gives the information to us, it's a credit purchase or credit sale. In academics, we want some uniformity. If it is given sold goods to Mr. Ramesh, 20,000, it's a credit transaction. Sold goods to Mr. Ramesh for cash rupees 20,000, sir. Cash. Don't look at the word rupees. Rupees is for mentioning the value. Rupee is not your cash. Rupee is a value, that's all. Once again, sold goods to Mr. Ramesh for cash 20,000 rupees. To
Cash account to sales. Sales.
Quickly. Yeah. Discount. Next one. Sold goods on credit to Manish. Manish account debit to sales 10,000. Next one. Paid to Morgan. Who is Morgan? Morgan is our supplier. In the previous case, we purchased goods from him. Now we are paying to him. How much he purchased from him? 20,000 rupees what he purchased. Now we are paying him only 19,500 and he is selling it's okay, 500 rupees I don't want. That 500 rupees is called cash discount. Please understand there are two discounts. One is cash discount, another one is trade discount. Okay. One is cash discount, another one is trade discount. Trade discount is nothing but a discount which is given on bulk purchase by the supplier to the customer. Bulk purchase. One laptop is 20,000 rupees. You are buying 1,000 laptop. He is telling okay, the 9,000 is enough. The 1,000 is called trade discount. That need not to be recorded in the books of account. Now in this transaction, laptop account debit 19,000 into 1,000 laptop. That should be debited. To vendor account 19,000 into number of laptops purchased 1,000. Okay. That 1,000 should be ignored. It should not come on account at all. What concept it is? Cost concept. You remember we studied cost concept. How much you are agreed to pay, how much you are paying, that only to be recorded in the books of account. List price is no matter. He is returning the list price. One computer is equal to 20,000 rupees. That's list price. We negotiated, we bought it for. After 3 months, you are going and giving the money. That time, he has given the time for you 6 months, but you are paying it within 3 months. You are asking, sir, he told 6 months time, but I am settling it within 3 months. Why don't you reduce some more money from 19,000 to 18,500? That 500 is called as cash. That needs to be recorded because already we promised to give you 19,000 per laptop. Now we are giving only 18,000. That 500 needs to be recorded. Same thing here. We are paying 19,500 to Mr. Mohan. Okay, so entry is Mohan account debit 20,000. Mohan account debit 20,000. To cash 19,500. To discount received. Don't write cash discount. When you say in accounts discount, that refers to cash discount because trade discount you are not considering in the books of account. So to discount received account. No, don't say cash discount. Discount received account. Because you may also allow your customer to pay less. That time it is called discount. But that is discount allowed. This is discount received. Actually, discount received means you are not receiving anything. You are paying less than what you are supposed to pay. You are paying less than what you are forced to pay in the beginning in the middle. Okay. So entry is Mohan account debit 20,000 to cash account 19,500 to discount received account 500. Okay. Next one, sold goods to Rai & Co. Rai & Co account debit to sales 5,600. Received check from Anish in full settlement. Bank account debit 10,000. Sorry, bank account debit 9,750. Discount allowed account 250. To Manish account 10,000. Why it is 10,000? We sold to Manish 10,000 on the 9th date. Yes. 9th date we sold to him 10,000 rupees. We are receiving now 9,750. So bank account debit 9,750. Discount allowed account. That's the rule. Nominal account rule. Debit all losses. That's the loss. 250 rupees loss. 250. Discount allowed account 250. To Manish account how much? 10,000. His account is settled now. Okay, next one. Paid for electricity charges. Electricity charge account debit.
Electricity.
One. Paid rent by check. Paid rent by check. Rent account debit to bank account. Rent account debit. Debit all expenditures. Rent account debit to bank. Credit the giver. Who is giving this money? Bank is giving on behalf of you to the landlord. Next step. Oh, 4 more minutes. Next.
All these entries are made like.
Come down. Answer is here. Okay, whatever I discussed, answer is there. Come down. One more 2 transactions I can see. Look at this. Can you tell me Kovinath commenced business with cash? Cash account debit to capital account. Next one. Once again, those who are online, please tell me the second one. Anybody? Paid into bank. Online.
Bank account.
Debit.
Bank account to Gopinath.
No. Second one. First one itself is wrong. That is cash account debit to capital account. Or Gopinath capital account. These are 2 proprietors. Second one, pay into bank account debit to cash. Next one, what goods for cash?
Purchase account to cash account. Purchase account to cash account.
Very good. Next. Wait, one second. What?
Furniture account to cash account.
Furniture to cash, not purchase to cash. Yeah. If you make
Furniture to cash.
called as error of principle, that means you are not recognizing the revenue expenditure, but you are recognizing as capital expenditure. Furniture. What is furniture? Suppose for Dayananda University, furniture is fixed asset. Fixed asset. Fixed asset. For Fatima, furniture smart. Furniture is a current asset, goods, specifically goods.
Assets.
So when Fatima furniture buying furniture, you try purchase account debit to cash or vendor.
Cash account.
If Dayananda University buys furniture, that time you write furniture to cash or vendor. That logic you should understand. Suppose the goods, for what it is purchased? It is purchased for using in the business. Name of the goods should be debited. If it is purchased for just processing it or just selling it, that time you have to write purchase account debit. The difference you have to give. Almost time. So please read about. I have sent some videos. Have you seen? Yeah, few videos are there. Every concept is already explained in the YouTube. Please see that and try to understand how it is. Make your assignment based on this. You have to take some transaction like this on your own based on the business what you are starting. Okay, and you have to make some 50 transactions logically. You cannot write bought furniture, sold land. You can do all 1 second, madam. Just 2 minutes. I understand. Just 2 minutes. Okay, I'm so sorry. 50 transactions you take, don't take random transaction. You take the transaction based on the business model what you propose there. And make journal like this. Make ledger. How many ledgers? There in the journal document account you have to make ledger and you have to make one trial balance. What is trial balance? The balance of all ledger accounts you are writing in a tabular format. The table is called trial balance. Any doubt? You can call me after 7 o'clock any day of your making of assignment, but don't prolong it till the last day. Okay, keep it a spaced manner, prepare it and submit. Okay, thank you so much. See you again. Thank you so much. Special thank you for Iman. Those are online, we are winding up. Anything you can ask me through WhatsApp or through mail or through call. Is it okay?
Thank you,
Sure,
sir.
sir. Sure.
Thank you, sir.
Thank you.
Thank you.
Thank you. Thank you, sir. Bye-bye, guys. See you next time.